Morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Your equity market on the S&P totally unchanged. TK, we are 90 minutes away from inflation data in America.
Yeah, to me the headline is the equities won't go down. They did not go down yesterday, and I'm going to link in the prosperity of the markets, the real economy, into this inflation report in 90 minutes. I mean, this is what people want to see, and to go from inflation to the Fed, the ECB you mentioned earlier,
Sure.
Bank of Japan, December 19th. You know what? It's a set of good news into year end.
You just wonder, TK, what's more important this week? I'm sure you guys talked about it yesterday. Lisa, the data, CPI, retail sales, or just the tone of the news conference from Chairman Powell at 2:30 Eastern tomorrow.
Which should matter more, I think, is the data. I'm going to just make a moral statement there. What will matter more potentially could be how asymmetric the potential risks are to over-tighten or under-tighten, and whether they are open to cutting rates in March as the market is expecting.
To your point of the data, the key observation I've had in the last 10 days is Gina Martin-Adams of Bloomberg Intelligence Equities, where she said everyone's focused on monetary dynamics, you know, the LM curve, if you will, and the IS curve, the real economy is where we are. Judd, you mentioned this when we sat down. You walked in the door at 5:55, and I got you in the first minute, and you said productivity matters. And the answer is productivity matters.
That's part of the Ed Yardeni call for 6,000 on the S&P 500 by the end of 2025. I think we've got to ask going into tomorrow, are we seeing signs of a credible slowdown in this economy? Morgan Stanley thinks we are. Other people might be pushing back. I can tell you one company that is. It's Hasbro. Lisa, cutting 20%, almost 20% of the staff in the holiday season, 2 weeks before Christmas.
It's just kind of brutal. I mean, just emotionally, for people to see that the toy maker is not going to do well speaks volumes about what's going to be under the tree. What I'm thinking of is it just isolated to the goods sector. Ernst & Young coming out in the Wall Street Journal this morning, laying off dozens of partners in part because attrition wasn't as great as they expected. In other words, people aren't leaving. They beefed up during the pandemic, and people aren't leaving. The quits rate is really coming down. This is important. There are signs that people aren't as liberal about their opportunities as they were during the pandemic.
They've had 39,706. The original Slinky walking spring toy, metal Slinky. Did you have one of these, John, as a kid?
Yeah, the thing that goes down the stairs.
Are you going to buy it from Amazon, or are you going to buy it from Hasbro? That, to me, is the point.
You probably go to Amazon for that.
Amazon. I think they affect all
How much
of
of it, Tom, is that
analysis.
over at Hasbro? How much of it is just the post-pandemic normalization? All that goods demand has just shifted. And to Lisa's point, a lot of people these days, they want the software, not the hardware, from places like this.
Yeah, I think the app thing is tangible. I don't know how to gauge it with a 8-year-old or a 10-year-old or a twerpy 16-year-old. I mean, I wouldn't know what to. 16-year-olds don't need toys. They need
money,
tuition.
But
money.
so I will just say that
Can you just give us
can
money?
buy Hasbro on Amazon. Just want to
Can you sell it to me?
Yeah.
Can you sell Christmas to me?
The entire show is going to be, let's just move on.
Did you two have a fight yesterday?
We did. We had a massive domestic.
No, it was great.
Thank God our agent got in the middle of it.
You noticed how I asked Lisa that question, not you. Yeah, you'd never tell me the truth. Here are the scores on the S&P 500, 90 minutes away from that inflation data. Equities going nowhere. Yield to lower again by 4 basis points on a 10-year. It's a break of 420 of 419.10. In the FX market, the euro a little stronger, dollar weaker here across G10. At least that currency pair 107.98.
The main event coming up in 90 minutes, 8:30 a.m. We do get the U.S. November CPI. I'm watching core CPI. I think that's going to be the most interesting. It is expected to stay flat at 4%, way above the 3.1% expected for the overall headline CPI. At 1 p.m., this is probably the issue between Tom and me this morning. I really think that the auctions are important, and he keeps denigrating them and saying that they're not important, and it really cuts, just cuts deep into me. Today, Tom, there's a $21 billion 30-year bond auction, and I want to see whether it goes well, because the last time it didn't go well, and it actually roiled the whole market.
She's going to burst into tears. Pick it up, Jen.
Okay, also, Ukrainian President Volodymyr Zelensky is in Washington, D.C., meeting with President Biden. We are expected to hear some sort of press conference, and I'm curious to see whether he actually can do anything, because there is a feeling that this is futile based on some of the disagreement in Congress. And we heard from Terry Haynes. He doesn't see this as an exercise in futility. He does think that there's a possibility to get a deal across, but he was placing the emphasis on the Democrats coming to terms with something with border control. Honestly, that's very fuzzy to me. I don't have a full understanding of what's at stake and where the push-pull really is.
From where we were 8 months ago, or 1 year ago? Wow, what a change.
Big change.
Big change.
AMH coming up in about 10 minutes from Washington. Look out for that conversation with our Chief Washington correspondent, Anne-Marie. With us now, Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, always wonderful to catch up with you. We're seeing some signs this rally is broadening out. The breadth is improving. Is it the real deal this time going into next year?
Yeah, John, right now it's a Fed pivot party and we're all invited. So markets have been celebrating this idea that there's disinflation in the pipeline. Of course, we get CPI later on this morning, but you remember that October CPI report was absolutely pivotal for the markets. It was amazing to watch. It missed by 0.1%. And we saw this massive rally in bonds. We saw the dollar weaken, and then the party kept going with risk assets rallying. We've got high yield bond spreads well below 4%. We've got Bitcoin rallying, well, until yesterday, and other higher risk parts of the market. Meme stocks back in the headlines. So investors are really celebrating this idea of disinflation. And of course, in November, we got the best month since the 1990s for a balanced portfolio. We've pulled forward a lot of excitement, I think, about disinflation here. So I would expect the market reaction to be a bit more muted, even if we continue to see inflationary pressures subside into next year. And I think, you know, if you look at Matt Miskin and I just penned our 2024 outlook, and we called it Stocks Are Stories and Bonds Are Math. And the idea, and we can talk about this, is that there's been a lot of value unlocked on the fixed income side, where there's actually been less value created on the equity side as a result of multiple expansion this year.
Emily, what does cash do next year? If I believe in productivity, if I believe in a post-pandemic America, do I regret being in cash in the first quarter?
Yeah, it's a great question. Right now, there's about $6 trillion sitting in cash nearly. It is remarkable to see this swell of money that's just sitting there in money market accounts and the equivalent. And our view is that you want to be fully invested into next year. Yes, we may see some challenges on the equity front, again, as valuations are very fulsome right now. But we think bonds can play a bigger role in portfolios in the next year. You know, we came into the year at about 4.8% on the 10-year. We went to 5. We're back down to 4.2. But there's been, 3.8 coming into the year. There's been a lot of value unlocked there. We're looking at income on high-quality bonds of 5 to 6% as being really, really attractive. And then we think that equities can continue to chug along here. So I think cash, unusually, after the last year or so, it might actually be the biggest drag to portfolios into next year.
Which goes to your point that it's a Fed pivot party and we're all invited. What do we have to see today in the CPI report to give legs to that kind of narrative?
Yeah, I mean, I think you certainly don't want to see it surprising on the upside here. I think a lot is sort of, the narrative really has been that you can see, of course, headline CPI coming down here a little bit as gas prices have come down. You might see a modest move higher here in core CPI, areas like hotels, used car prices. There may be a little bit of noise in the data due to the UAW strikes being over. So, that may have limited production on the car, on the auto front. So a little bit of noise there, but I think, markets are really expecting a continued moderation. They're pricing in, 4 or 5 Fed rate cuts next year, which might be a little bit aggressive, especially going into the Fed meeting on Wednesday.
So where do you lead in and where do you push back?
Yeah, so from a markets perspective, again, right now we're leaning into, owning areas like mortgage-backed securities, municipal bonds, investment-grade corporate bonds. Those are really the areas that we think can offer value. We still are finding opportunities in equity markets. Frankly, we were surprised by the multiple expansion this year. You look at the returns in stocks, over 20%, 13% of that just came from PE expansion. And then you get this big re-rating in earnings estimates, which also contributed another 6% to total return. I just think that's going to be hard to come by again into next year, especially since the S&P 500 is now sporting a 19 times forward multiple on top of 12% earnings growth being penciled in. A lot of that, of course, the Magnificent Seven drove the returns this year. You got to be a little bit worried about their ability to do heavy lifting in portfolios next year. We still like it. Higher quality, great balance sheets, lots of cash. We want to own it. We think it makes sense to pay up for it, but we also are looking to diversify into areas like U.S. mid-cap stocks, more defensive equities, in order to balance out that portfolio into next year.
Let's finish on that Fed pivot party. You say everyone's invited. I'm going through the guest list. There's one name missing. Did Chairman Powell RSVP?
Yeah, I think he's going to want to throw a little cold water on the party, or maybe he's the parent that's shooing the children away from the keg when the meeting happens today. You know, I think he's got to push back against easier financial conditions. It was the last Fed meeting that really, again, caused this kind of exuberance across markets. He suggested that the risks are balanced between doing too much and doing too little. I think Powell's got to push back. He's going to come out a little bit hawkish today and try to temper those expectations that the Fed's going to be cutting aggressively in 2024.
The two-day meeting begins today. I don't think there's a keg party going on down in Washington at that particular meeting. Emily, thank you. Emily Rowland there of John Hancock Investment Management. Emily, have a wonderful Christmas if we don't talk again before the holiday period. Lisa, how credible is, and this is the question Bank of America's asking, how credible is a hawkish hold tomorrow? This market's just on its own planet, living in its own world, and it doesn't need Chairman Powell endorsement, does it?
It's exactly what I was thinking as Emily was talking about this. She basically is expecting hawkish sort of talk that she will then disregard because it's a pivot party and we're all invited.
That's what's happening.
Which is essentially the entire market's attitude at this point,
Right.
given the fact that maybe there's a credibility gap here.
That was brilliant, what she said there. And this is so important, folks. Let's put this in perspective. And John, this is what everybody got wrong in January. A year ago, we're going to have multiple compression. It's over.
Because
we're
rates
gonna
are
slip
up.
back under 20.
Yeah.
The whole real economy, real stock market analysis away from the Fed. Price to earnings ratio, price of stocks is compared to earnings. The Standard & Poor's 500, everyone agrees 21.23 is a lofty statistic. You take the reciprocal, we're not going to do that now. Apple, 31.57. That's what Emily Rowland nailed.
Fundamentals haven't been great at that company over the last 12 months.
The
Stock
profit
returns,
has been great.
phenomenal.
If you
I'm
look
talking
at it,
iPhone
it's
sales
growth.
specifically.
Yeah, growth. It's not a growthy story except for services, but it is for profit.
Amazing gains. If you are just joining us, welcome to the program on the S&P 500, almost totally unchanged here, positive 0.01%. Yields are lower by 4 or 5 basis points, 418.53. And for me, this is it, Lisa, going into tomorrow, CPI later on. Ultimately, looking to see how the market responds to Chairman Powell. That's it, in the news conference. And let's say we get that hawkish hold. We know what happens if he endorses market pricing. But if we get that hawkish hold again, does this market just continue ignoring him?
Honestly, yes, that's what we just heard from Emily Rowland, unless there's some specific details about why they are going to be more hawkish and not necessarily cut rates as soon as March. To me, it just seems like the market's going to disregard that, which is the reason why I'm actually more interested in the actual numbers, the CPI report, the retail sales, what exactly is going on at Hasbro, what exactly is going on at Ernst & Young, how much is the economy cooling beyond what we expected, and are cuts necessarily good for risk assets?
I'm with you on retail sales. Just on the retailers, they're coming into the holiday season, they're guiding us cautiously, and then we see the numbers come out of Black Friday, Cyber Monday, boom, supported by Buy Now, Pay Later. Going to see what they look like when we get the numbers on Thursday morning. CPI just around the corner, retail sales in a couple of days' time. The Federal Reserve is the meat of the sandwich in between. That's 24 hours away.
Did you practice
Thanks,
that?
guys. Just made it up. All right.
This is Daybreak Europe. I'm Kriti Gupta. Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
I will not endorse prior to the Virginia primary. I'm going to let Virginians choose. And second of all, I firmly believe that Americans, Republicans, independents, and a load of Democrats understand that we can't, as a nation, afford another 4 years of Joe Biden.
That was Governor Glenn Youngkin of Virginia, speaking exclusively with Bloomberg's Anne-Marie down in Washington. We'll catch up with AMH in just a moment. Here's the stage is set as follows. The price action looks like this on the S&P 500. Positive 0.02% on the S&P. We are unchanged. Yields are lower by almost 5 basis points, down to 418.72 on a 10-year. The dollar is weaker, the euro stronger, 108. 108, reclaiming 108. That currency pair is firmer by a third of 1%. The inflation data is about 1 hour and 13 minutes away. Citi's Andrew Holdenhorst publishing just moments ago saying not a nice and neat slowing to 2%. We think this type of inflationary backdrop will make it hard for Fed officials to cut rates until activity data are more clearly weakening, which is why so many of us are looking ahead, not just to CPI this morning, but onto retail sales, TK, on Thursday, 2 days away.
Retail sales to me is a huge deal. And, within all this data, including what we see this morning, is, you mentioned this earlier, John, the service sector dynamics still front and center. There's an assumption of goods deflation, outright deflation, like outright deflation with pork in China. This is not about pork. It's not about goods. It's about service sector. Is it quiescent?
We've seen the rebalancing in goods, and you're right, Tom. That's the next step. We're going to see it elsewhere. That was perfect, TK.
Okay. That's, where we are this morning. But I look here in 10 minutes or so, and it's different off of the jobs report on Friday. Is it about the real economy and employment, or is it just rates, Fed talk?
Wall Street versus Main Street.
Yeah.
Wall Street's looking at the month-over-month figure, working out whether the Federal Reserve is going to surgically reduce interest rates or go all at once. Main Street's focused, Tom, as you know, on the sticker shock of the cumulative inflation over the last 3 years. That's the difference.
The cumulative inflation is tangible, particularly in Virginia. Anne-Marie Horton, in conversation with the governor of Virginia, our Bloomberg Washington correspondent last night. I believe the election results weren't so lovely for the governor of Carlisle. Republican in name only is probably what Mr. Trump would say. What does Glenn Youngkin, in your conversation yesterday, what does he symbolize to disaffected Republicans right now?
Well, he has a purple state, right? So for him, it's about a balancing act. And yes, he went into the Virginia elections in November, almost calling Democrats when it came to that. And a lot of these races were very close. He's very optimistic about term. But what he's dealing with is less money. Pandemic aid money has dried up. And he's going into a divided government, even more divided, given the General Assembly is now completely controlled by Democrats in Virginia. And he's looking at a potentially what him and his economic council are thinking is a mild recession next year. So this is how he's framing how he's going into next year. And in his purple state, he has to balance, the populists and the neoconservatives of the Republican Party.
Well, take it to the presidential election. Terry Haynes was brilliant on this about 10 days ago. If there's a lot of Republicans out there like Youngkin, perhaps distant from the former president, how does President Biden get them to vote for him?
I don't see these Republicans voting for Biden, even if they're not a fan of Trump. And Governor Youngkin didn't say he wasn't a fan of Trump. He just said, I'm not endorsing anyone until the Virginia delegates make their decision. I'm standing by Virginians. You know, he's very smooth in trying to answer these questions because he's still courted. I mean, some of that buzz has really evaporated given the fact that he didn't flip Virginia red. But individuals, especially donors, really see him as the future of this party. You know, what we're seeing right now in the Republican Party is they're about to nominate a man who is going to be older than Joe Biden was on his inauguration day, who lost the 2020 election. And they're going to see really a generation of Republican executive talent pushed to the side. Glenn Youngkin is term limit. You have Ron DeSantis, Brian Kemp, Mitt Romney is leaving the 7th. People like Speaker McCarthy, people in high-value leadership positions who can do these jobs are leaving. So it remains to be seen what happens. And if Trump were to win, he's only one term. This really sets up a wide field for 2028 for anyone that's willing to stick around.
A wide field on the Republican side. There's a question of how wide the field is on the Democratic side as an increasing number of polls show President Biden on the back foot in a theoretical matchup with the former President Trump. How much sweat is there in the White House right now?
Listen, the White House will tell you, or the campaign at least, because the campaign's the one that's supposed to be talking about the polls, you know, there's obvious concern, but they still have a year out. And President Biden is sitting on a massive war chest of money that they can deploy. And I think at some point, once the Republicans go through their primary, the early to mid next year, they will start going to spend a tremendous amount of money. I believe he's sitting on $91 million right now. And
what tangible types of items do you think will come from that? How much pressure to get something passed for aid to Ukraine by year end?
It was around this time last year that President Zelensky was here, and it was triumphant and jubilant, his visit. He was greeted as this war hero. Then he came in September. It was a bit more toned down. Remember, we weren't even sure if he was going to meet with then Speaker Kevin McCarthy. And now it's definitely more of an awkward meeting. Not for the White House, where he'll receive a warm reception, but he's going to have a very tough time in Congress. You already have individuals like Senator J.D. Vance saying Ukraine is one of the most corrupt countries. He's going to meet with Speaker Mike Johnson, who is struggling in the House to see whether or not Republicans would back Ukraine aid. You know, he was elected after they rejected Speaker McCarthy. So this is going to be a tough one for Volodymyr Zelensky. He doesn't want to wade too much into the internal politics of the United States. He's probably not going to touch the issue on the southern border, but he wants to make the case that Ukraine is the last country standing between Russia and a NATO ally, and that is why it's imperative for the United States to continue supporting Ukraine. He said yesterday, standing alongside Lloyd Austin, that the only thing that this helps, this acrimonious nature of what is going on in Congress, this only helps Putin and his sick clique. That's the type of message he's going to deliver today.
AMH, thank you. A big challenge to try and deliver that message, TK. It may well fall on deaf ears.
Well, she went through the last 12 months in the evolution here, and I guess it's like any other war. It starts, it's going to end quickly, and then not.
And fatigue kicks in, and people don't want to support it anymore.
Fatigue, financially fatigue, and I saw a blurb the other day, I'm sorry I can't cite it, where they're literally running out of ammunition in all sorts of European nations. Yeah, I'm using ammunition in an amateur way, but the fatigue, John, that's the right word.
You know, I just wonder, especially as we head into the election, how much there really is a sort of nationalistic focus of voters versus some international heft, whether there still is this feeling that people want to participate on the international stage. And to me, I'm uncertain on that. I've seen conflicting polls about where the focus is, specifically in subsets of the population based on age, based on affiliation, party affiliation. It's one of the big questions.
I think the new isolationism, which I can't characterize because I don't know what it looks like, is partly of the historic isolationism of America. There's no question about that.
Coming up, not on this, on markets, on fixed income, on CPI, on retail sales at the Federal Reserve. Rob Waldner of Invesco. That's coming up shortly. Equity's just about positive on the S&P 500. Yields coming down by 4 or 5 basis points, 418.72. We are 1 hour and about 4 minutes away from inflation data in America. From New York City this morning, good morning.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Equities on the S&P going absolutely nowhere. 60 minutes from CPI. Here are the scores on the S&P 500. Firmer by 0.1%. On the Nasdaq, up by 0.2. Decent couple of days of gains on the S&P 500, even with that weakness in big tech yesterday. Into the bond market, 2-year, 10-year, 30-year. What a change for the front end of the curve. We were getting used to yields near 5%. Now we're back down to 468.25, down a couple of basis points. When we did the November CPI report 12 months ago, Lisa, we were talking about a 7 handle. We're not doing that anymore.
We're talking about 3.1%, the expectation for headline CPI. And yet what I'm interested in, honestly, is when you go under it and you look at the excluding energy, excluding food, we're looking at a 4% inflation rate that's probably sticky. This is what's causing some angst for the likes of Lindsay Piegza, who's saying you got to be a little concerned about this.
So we've got the data, CPI, then retail sales on Thursday. Then you've got the tug of war between 2 central banks. You've got to push that through the FX market. The euro against the dollar shaping up as follows. On the euro at the moment, about 108.03 against the dollar. That's a stronger euro, weaker dollar through G10 this morning. That currency pair positive by 0.3%. Lisa, the Federal Reserve, it's going to cut next year, according to pretty much everybody under the sun, with the exception of maybe Lindsay Piegza. The ECB is going to go first. That seems to be the consensus view, which is why up until recently started to see just a little bit of euro weakness coming through the market.
At this point, I do wonder whether parity is a call that a lot of people can get behind, as BNY Mellon's Jeff Yu is talking about, or whether you could see surprising upside at a time when the French stock market just reached another all-time high.
Germany too.
Germany too. I mean, people are talking about weakness. Where is it?
There's been a gross underestimation here, and it's a data gathering, and it's about the pandemic. And might I point out the shockingly close Ukraine war. So I think it is a jumble. I would go back to the culture, John, and you're going to see this in Davos. The basic idea here that the ECB has to listen to the Bundesbank. The Netherlands electorate in complete turmoil there over the last 12 months. So I would suggest there's a political and cultural overview here that there's not in Washington.
Yeah, the inflation, without a doubt, deeply unpopular in the nations that you just talked about, Tom, and everywhere else as well. Let's get you the top stories under surveillance this morning. We're an hour away from the latest CPI print ahead of tomorrow's Fed decision. Bloomberg Economics expecting headline inflation to remain flat for November, with a slight uptick in a monthly read on core. Bloomberg's outlook seeing core inflation falling below 3% in the first half of next year, which is why so many people think, Lisa, rate cuts are just around the corner.
Because you are getting that good disinflation, and you can just sort of cut rates in tandem with a disinflationary kind of bent. How much does the Fed chair lean into that? I'm guessing not at all, and I don't think anyone cares.
And if he does push back, precisely, does it matter, Tom? If you get that pushback, you get that so-called hawkish hold from the Federal Reserve tomorrow afternoon.
It's part of it, but I'm going to go to my recent overestimation, or my overweighting, I should say, of the real economy in this new, better productivity. That wasn't in the equation, the mathematics, the soup of it in spring of last year.
Let's get to the latest from corporate America. We've talked about the job cuts, almost 20% of the workforce going over at Hasbro. The holiday shopping season proving to be not great. Here's the latest from Oracle, continuing its fall this morning after posting disappointing results in cloud computing. The software and database company posting 2 consecutive quarters of slower growth as competition builds with Amazon, Microsoft, and Alphabet. The chairman, Larry Ellison, defending the outlook, saying demand for cloud services is, quote, over the moon. The question with this stock down 9% this morning, Lisa, is whether this is an Oracle problem or some kind of signal about what's happening elsewhere.
Exactly. Is this a sort of story of the year, which is consolidation among the biggest tech giants of market share, particularly with cloud computing? Or is this the suggestion that maybe companies are spending less? Based on the performance of AWS, Microsoft's Azure, I would say probably this is an issue with Oracle losing some of its market share to the giants, which we've seen consistently throughout the year.
We're exhausted from the soap opera of what, 4, 5, 6 weeks ago, AI, open AI, close this, whatever it is. And the answer is, you know what? It's about engineering. It's about engineering, what AMD is going to do, Microsoft racing to catch up with NVIDIA, and that's about American technology.
Do you want the last update? Here's the last update. Harvard student newspaper The Crimson reporting President Claudine Gay will remain in office even as pressure builds following last week's Capitol Hill testimony on anti-Semitism. More than 1,000 students and alumni calling for Gay to resign. Another petition in her defense earning the support, Tom, of 700 faculty members.
I want to know where the other 200 schools are, whatever the number is. I'm not informed on that, but I find unseemly the focus on 1 or 2 or 3 schools. There must be a lot of other schools in the same boat, the same debate, and they're just beneath the radar. That's unfortunate.
Amazing, Tom, to see the shift in tone that I've witnessed. The embodiment, I think, of the liberal elite, the establishment, people like Fareed Zakaria over at CNN, with an incredible monologue over the weekend. Neil Ferguson writing this in the Free Press, Tom, on the intellectuals, and the treason of the intellectuals. And this quote at the moment, Tom, I'll read that to you.
Please.
I have also witnessed the willingness of trustees, donors, and alumni to tolerate the politicization of American universities by in a liberal coalition of woke progressives. The pushback you're starting to see, Tom, is getting bigger and bigger.
I put this out on Twitter and LinkedIn. It is 10,000 words, and it deserves to be read. And I'm going to go back to a book that was changing for me somewhat like Schindler's List, and that was the Book of Abraham, Marek Halter, the great French philosopher, modern philosopher. And Neil Ferguson uses that heritage, that European and Germanic heritage of an ugly 1920s. I mean, it's a tour de force.
I just hope that this really launches a question around what is free speech. It's not just simply allowing certain speech and not others. It's this question of not having some sort of implicit censorship of different viewpoints and different concepts.
Patiently waiting as we discuss these events, these moments that we're in. Rob Waldron joins us, Chief Fixed Income Strategist, Head of Macro Research at Invesco. Rob, these are delicate conversations, and one of the delicate conversations for Invesco and finance is a 15% bond market loss. That's the drawdown roughly. And there's been a nice recovery this year. Into next year, is there an inertial force where you get a better bond market just because 2023 was better?
Well, Tom, I think it's clear that next year we have the tailwinds behind us for the first time in quite a while in fixed income. So it looks like we'll finish this year in positive territory, which is great, 2023. But in 2024, I think the question is not what direction interest rates are going to go, but how quickly the Fed will cut. So we either have a slow cut, which is based on what you might call maintenance cuts, as the Fed realizes inflation is low and will stay low, or a quick cut, which would happen if the Fed overstood their welcome, kept things too tight, and created a more impactful slowdown in the economy, and they had to move quicker. So we're really on a path of either slow cut or quick cut next year, and both are pretty good for bonds. So valuations are a little bit rich right now, but I think it sets up great for 2024.
So basically, you're leaning into Emily Rowland's pivot party. You were invited, and you're playing.
Yeah, absolutely. I mean, we think we're in a slow growth, disinflationary environment, and the data now is pointing to that. I mean, Atlanta GDP now for the fourth quarter is coming in, I think it's 1.2 right now. We get the CPI data today. The market's leaning a little bit, I think, on the bearish side, or the low side of the 0.3 that we see as the sort of consensus. So, today there might be a little bit of noise, but clearly, inflation in China China's in deflation. Inflation in Europe is coming down much faster than most people expected. Inflation in the U.S. is coming down, and we think we're in a continued disinflationary environment.
The question is really, what is the weakness that accompanies it, which really raises the question of, do you go into government debt, or do you go into corporate debt, in particular risky corporate debt, and do you go into some of the small caps and others that are more leveraged to the economy? Given the fact that we're looking at high yield spreads that are the lowest going back almost 2 years, or actually more than a year, there's a question of, have we overpriced the risk of a soft landing?
Well, we've probably, we think the soft landing is the base case, right? So pricing to the soft landing is not a bad thing to do, but we do need to be very cognizant of the potential, a harder landing, a recession. And, certainly credit spreads, particularly in IG, actually, Lisa, are very, very tight. In credit industrials are pretty tight from a spread perspective. But if you go back to an all-in yield perspective, they still look very compelling. And in our base case, where you get this disinflationary, slow growth disinflation this year, I think which all signs are pointing to, that will be good for credit across the board.
Rob, as a civil engineer, you understand partial differentials and partial derivatives. And one of the answers in the yield space is all of a sudden use of cash in the equity space is a challenge. In the next year, are we going to see a migration of middle ground balanced portfolios towards equities if this market expands and away from bonds? Are people going to go for total return of equities over the coupon of yield?
A great question, Tom. And actually, I'll take a slightly different tack at it, which is with the real yields where they are, which is historically extremely attractive, investors will continue to look for the bond market. They can really get a lot of what they need from a term perspective from the bond market. Also, equities will do quite well in the environment that I laid out. So the place where the source of funds is likely to be cash or money market funds, these types of things, which have been very appealing because they have a high yield and very low risk. But they have one risk that, I always say that money market funds and cash have one risk, which is prepayment, reinvestment risk. And so if you get, the bond market doing well, the equity market doing well, that is likely to draw cash off the sidelines into the markets. And we think there's a lot there.
Rob, wonderful to get your view. Thank you, sir. Rob Walden there of Invesco.
Thank you.
Lisa, this is a question of what's the trade of least regret going into 2024. In 12 months' time, I think we've asked this a few times. In 12 months, will you regret not locking in that yield, reinvestment risk? Or will you be happy that you're in cash and you could deploy it on pullbacks on the S&P 500? Given the move we've had in the last month, I think extrapolating that out, you know the answer. But that's the question you've got to ask going into next year.
Where are the dips? This is the problem.
Yes, I haven't seen many.
Yeah, this is the real issue. If you want to buy on the dip, which is what so many people have been saying for so long, then they wait for the dip and then it's 1% down. Oh my goodness, everybody jumps right in. This is the problem when everyone's been doing the same trade of short-term cash.
I'm going to say something I've never said, and I haven't framed it. And John, I have no evidence. I've never seen a record high Standard & Poor's total return, Dow total return, with less exuberance than we're in right now. I've never seen it. I'll go back and look. Somebody will say, hey, stupid, look at 1990 this, 18 this, whatever. I've never seen such a lack of exuberance.
Is this because we're basically where we were 2 years ago?
I think, yeah, that's a really good point. We've basically gone round trip, and now we're trying to add to that to new record highs. That's a really good one. The 24-month total return is
punishing.
Yeah.
It's been exhausting. If you're just joining us,
exhausting.
Welcome to the program. The show continues. Equity futures on the S&P 500 positive here by 0.1%. Yields a little bit lower by 4 or 5 basis points, 418 at 53. The standout corporate story of the last 24 hours. There is a toy maker in America which is cutting 1,100 jobs, almost 20% of the workforce, 2 weeks before Christmas. Their stock is down 5% in the pre-market. It's already lost about a third of its value, Lisa, since early September.
I remember when people played Dungeons and Dragons and had My Little Ponies. Look, there's a question here. Is this just an issue of people going to Roblox and that's where kids are? Is this a company that really excelled during the pandemic where everyone was desperate and that is just feeling retracement versus really kind of signaling something that we're going to see in the retail season, especially because there was a report about small business optimism that came out this morning that was worse than expected. So on the margins, you are seeing a feeling that maybe people are running out of patience.
Torsten Slok has his slide. He puts out a slide every morning, folks. I know you guys saw it, and his bankruptcies are spiking up. They're not 08 grim, but there they are. And I'm going to go back to two Americas, and I think there's a half of America. They don't care what the grocery price is. They're going to celebrate the holiday season. And there's another group going, wait a minute, how do we get to February?
Well said.
Did I do okay there?
Absolutely, totally agree. Totally agree.
Come back tomorrow?
You can come back tomorrow. You can take Friday off. Long weekend for you, TK. Coming up next on the retailers, the 2024 outlook from Bloomberg Intelligence. That's just around the corner from New York City. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Yes, we're seeing inflation slow, but consumers aren't really feeling that right now, and they're still seeing a high level of prices, which is contributing to some of the consumer fatigue that we're starting to see develop and we think will carry on through 2024.
That was Sarah House of Wells Fargo. US CPI data about 45 minutes away. Our survey calling for a slightly lower headline figure. Jennifer Bartashas of Bloomberg Intelligence warning this. Retail staples companies, including Walmart, may face a difficult operating year in 2024 as waning inflation makes same-store sales and top-line growth more difficult. Stand out, I think, communication from corporate America in the last couple of months from the last earnings season, TK, for 3Q, was Walmart using the D word, talking about deflation in our future for their company.
And it followed up after we heard that from their CEO. I mean, John, this is important. This thing has legs to it, where their leadership is looking at what I'm going to be polite and call price flatness. It's tough to grow. It's tough to look at your fixed costs if you've got price level like that. What we're going to do here right now is give you a view to next year, and we do this with two of our outstanding people at Bloomberg Intelligence. Jennifer Bartashas joins us, and Poonam Goyal on your Retail America. Of course, retail sales on Thursday. We'll have all that for you. Jen, let me begin with you. Hasbro, John Farrell mentioning that Hasbro laying off loads of people. They distribute their product through your world. In the toy aisle at Walmart, how grim is it?
Well, you know, it is a weak season for toys, and there are a couple of things happening there. You know, first, the discounts just aren't as high as they were in previous years, according to the price study that we run every week. But also, it's that the consumer is being much more selective. And you have to remember that during the pandemic, people stocked up on a lot of things, like board games or things to keep entertained. So the demand has been a little bit slower, but overall, it still is a weaker season, and that's just reflecting where the consumer is right now.
Poonam, your Amazon note in your outlook is simple. They will battle, they will cut price to their retailers to compete with the other people. How's that going to play out 12 months and even 36 months down the road?
Yeah, I think Amazon will continue to pull share from the brick and mortars, notably as people continue to seek convenience and low prices. What we read and what we've seen in studies is that Amazon actually is priced best compared to most rivals, including Walmart. So that's encouraging and really drives shoppers to its platform again and again. Now, what's interesting is that while toys is off to a slower start because there isn't that many discounts, it was actually a call-out category for Amazon for the Black Friday selling week. It was a popular category. So the demand for toys is there, but people are being selective on where they get them and how they get them.
Poonam, do you see this as the beginning of something greater, basically a trend that can last, especially given the fact that we are seeing deflation when it comes to gas prices, when it comes to some food prices and some good prices?
I think the trend remains. The trend didn't start this year when, you know, consumers started to combat inflation. It's been around for quite some time, whether you look at it in the apparel space or in many of the other discretionary categories where people are making choices. They're figuring out where they can stretch their dollars and really maximize their spending power. So we think that trend is here to stay. What's going to drive spending as we move into 2024 is going to depend on the fashion. It's going to depend on the brands that consumers are seeking. And then on top of that, convenience and price.
Jennifer, from your perspective, how much is this a tale of two consumers? There's one who's looking at different fashions and kind of whether they want to buy that nice item or not. And then there are other people who are seeing what their grocery bill is and deciding whether they can buy extra things, right? I mean, in other words, are you seeing big differences in some of these trends and the weakening depending on which sector of the population different stores deal with?
It's very true. We are still seeing that division of the consumer, and people who are comfortable are going to continue to spend. But what is notable is, and we've heard companies like Walmart talk about this, they're getting trade down customers. So they're getting some of those higher income households coming into Walmart to buy groceries. And part of that just may be that people are looking to save where they can, and then they're splurging where they want to indulge themselves. But then you also have the consumer who is very tightly strapped. And so this is where retailers are really looking at the value play. And that's part of what's going to make it a difficult operating year for these retailers, is that they're going to have to keep prices competitive for a lot of consumers out there.
Jen, to both of you, and you don't do buy, hold, sell at Bloomberg Intelligence, but as a general statement, are your stocks richly valued? In the show this morning, we've heard about PE expansion and the rest. When you wake up, do you go, wow, these things are rich?
I'll start with Amazon. You know, it's the largest company that I cover, and we have argued that the cloud business alone is probably worth more than where Amazon sits today. So it depends on how you look at the businesses and how you value them. But we do think that when you break up or try to break up the pieces of Amazon, there's clear value and growth across each of its segments.
You know, I look, Jen, here again at the big boxes as well. I mean, John, we're looking at Macy's yesterday trading for a cup of coffee. I mean, the competitive landscape, do they just keep growing and growing, earning those 20 multiples?
I think that they do continue to grow in this environment. And if you think about it, you know, they have the greatest touch across the United States. They can touch lots of consumers, but they basically meet the need that's out there. And, you know, traditionally, staples are a more defensive sector. And we're in a period of time where value is king. And so these companies, you know, will be rewarded by consumer behavior by virtue of the type of businesses that they run.
It's two of the very best. It's always good to catch up with both of you. Bloomberg's Jennifer Bartashis and Poonam Goyal of Bloomberg Intelligence. I was just looking at this everything rally. The airlines, the rally off the low. The low, of course, at the end of October, just after bond yields peaked. Lisa, we've had a move of more than 27% on the airlines,
And
on the
this-
S&P 500.
This comes with the projection for record travel during the December break. This comes as oil prices go lower. This is going to be a huge boon to their potential margins, considering that they're not necessarily hedged in the same way. And third of all, this challenges the idea that people aren't spending. It's just what they are spending on, and it has been a story that has not gone away. Is this something that is going to be sort of a staying secular shift, where people buy fewer things and do more?
You know, we're going to get through the economics, 30 minutes inflation, the Fed, and on to retail sales. And on Friday, somewhere in the vicinity of 4:15, we have to calculate breadth. Are the airlines the kind of breadth that you see to catch up with the Magnificent Seven, or at least close the gap?
Rest of the market, Tom, is doing nicely over the last 24 hours.
It's been undersaid.
Yesterday was a bit of an interesting moment. Whether you think that continues is the bigger
I'd
question,
say,
ultimately, but we saw it.
Liz Ann Saunders at Schwab covers this nicely, and the answer is the breadth is there. It's been there for 30 days. I'll let somebody decide, but it's whispers here, but it keeps going. It's more than a whisper.
I'll just say this, Tom, if you're expecting the consumer to drop off a cliff, we're running him pretty hard into that, aren't we, in certain parts of this equity market?
Besides that, we've been wrong for a year. I've been wrong for a year.
Many others have been too. In the next hour, we're going to break down CPI for you. In around about 5-10 minutes' time, we'll catch up with Alicia Levine of BNY Mellon. And then we're going to get a view on the commodity market. Christian Malik's going to join us over at JP Morgan. He's been quite bullish on crude, still is, next year and the year after. It's a 2-year call, a multi-year call from JP Morgan that we need to get into. We'll do that in just a moment. And Lisa, after that, really, I think the energy story, part and parcel of the broader inflation story. The reason why headline is going to come in and why most people think it will is the energy correction we've seen over the last couple of months.
Which is the reason why people are looking at core, at X energy, X food, because that's going to be such a disinflationary and deflationary kind of force. Here's my question. Are lower oil prices right now a good thing or a bad thing when it comes to the inflation story? It's kind of a subtle point. But on one hand, it's a good thing because it means that the headline inflation number is going to come down and people's expectations for inflation drops, at least in the near term. But it gives people more spending power. It's basically a stimulus check in their wallets.
Isn't that good news?
Okay, but is it good? Like just good enough, not good enough?
Oh, you mean...
does it fuel spending
We don't
more
want to boost
strength?
spending too much.
Well, this is sort of the Goldilocks idea, right?
Isn't that a ridiculous moment to be in? Do we look at low energy prices and somehow we're trying to paint that as a bad thing?
Well, I mean, it could be
particularly when it's
weakness.
come from the supply side.
Okay, fair point.
Far
At the
more
same
interesting if you
time-
ask the question about the American economy, is it a good or a bad thing, considering we now produce more than 13 million barrels a day of this stuff?
I think that it just is a way of thinking about some of the drivers of inflation going forward.
Yeah.
That potentially were set up for the idea that oil prices could rise if there is the sort of supply withdrawal. And then second of all, you're dealing with something that essentially gives consumers more money to go out and keep spending.
Which is a...
Depends.
It depends. Kind of a good thing.
It depends.
Just so long as they don't come down too much. But if they come down too much because of demand, that's the objective.
Well, basically, you just don't want too much inflation.
It's very confusing stuff, TK.
It is.
Just trying to keep
1987
up.
today, Christmas movie.
I bet you agree.
Wall
you
Street.
understand. You follow. Don't make me feel dumb. Go, carry on.
You're too smart. That's the point.
Stop, Tom. Carry on.
Oh, no, we'll pick it up later. It's too important.
On 1987.
Wall Street. If you need a friend, get a dog. Gordon Gekko.
Okay, nice.
Yeah.
Good movie. Today. Nice.
1987.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
ECB hike or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
When you step back and you think about the cumulative inflation, I think that's what a lot of consumers are still feeling.
Inflation may be coming down, but going to the supermarket doesn't feel any better for anybody.
We have a Goldilocks issue here where we don't want them to spend too much, but we want to see activity.
The Fed needs to ensure that inflation is stamped out and will not return, which means caution.
I think that the inflation is going to look a lot less immaculate in Q1.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Inflation countdown clock at 29 minutes. An important inflation report. John, what part of it do you care about?
Very focused on Taldar Paper and Blue Star Airlines this morning. We can check them out in the pre-market. Do you like that?
I like that. It's
Wall
very
Street.
good.
Nice.
Very Wall
nice.
Street. 1987.
Nice.
Great movie. Margin call as well.
Can you imagine the control room sort of like trying to find the ticket?
they're like
two companies this morning. Where's
100%. That's what
Taldar
happened.
Paper,
Can we
Blue
book
Star?
Gordon Gekko?
Can we get Gekko?
Can we get him on?
We're going to park that. Let's focus on CPI. The number drops in 29 minutes. So we're seeing signs of a credible slowdown in the economy, not just disinflation. Morgan Stanley says yes. If we are, where does it leave Chairman Powell tomorrow? And a big question for so many people. Forget the data. Forget the decision, the statement, the projections. Focus on the tone of the news conference. Does the chairman of the Fed push back against the easing of financial conditions we've seen in the last month or so?
And what we see in 28 minutes, John, the basic idea here is we've had a glide path. It's in place. And the number of the dispersion of opinions here on how you go from 4 to 3, just as a round number, or 4 to 4.3. Lindsay Piegza, in an hour and a half ago, is looking for a rate increase.
Potentially. The threat of what from this Federal Reserve. So is that a credible threat? Do you think that is a credible threat from this Federal Reserve at the moment? Because this market's not listening, Tom. It's made its own conclusions about the future.
It is part of the probability distribution. It's not a credible threat, but given what events happen, you may see this. And it's still here with the bond market. And Lisa, I go to where we are and go, okay, we go level from here. Is that in the report here in 20 minutes?
Well, if we go level here, is that still the pivot party that everyone's invited to, that Emily Rowland was talking about? Is that enough that we just get stability and strength, and at least
stability doesn't do it for the Fed?
Well, it's not necessarily when it comes to inflation, but over the long term, stability in bond yields, because we're basically gaming out that the Fed's going to cut rates, but we still in a higher rate regime for a longer term. Honestly, to me, what I find interesting is that since rates peaked out in this cycle, on October 19th, around there, that's when you saw the massive broadening out. That's what's fueled everything beside the Magnificent Seven that has gotten serious wind.
Here's the reality. I looked at this. David Rosenberg was brilliant on this 2 or 3 days ago up in Toronto. John, it's simple. I look at the plane flights I look at, and it's rosy. It's wonderful.
It's busy.
Lower prices. It's great. I ordered groceries yesterday off the computer. It was outrageous. I ordered dog food for vet bill. It's outrageous. That's what people are feeling.
A lot of the people in this country, Tom, totally agree with what you just said.
Yeah.
And yet we're still having a conversation here on Wall Street about rate cuts next year. So let's talk about the rate cuts next year. The 2024 dot at the moment implies 1 cut, Tom, from where we are. A lot of people out there think that perhaps you add in an additional 2. This market, a lot of people in this market looking for 100 basis points plus.
Yeah.
Is direction enough? If the Fed moves towards you but doesn't get there, is that enough?
I think
they're
going to wait for the data, and we're going to see that here over the next 3 days. Michael McKee with his great leadership on that. The gust is so important. Let's get to the data. I got a bit of green on the screen here. I got a Dow total return record high, SPX within 1% of a total return high, John.
Equities right now positive by 0.1% on the S&P 500. Getting a ton of targets on the S&P for 2024. John Stolfus of Oppenheimer, the most bullish, seeing the S&P end of the year at 5,200. Alicia Levine of BNY Mellon, not far behind Tom, calling for 5,000, expecting a slow first half and a rally into year end. Down the other end, TK 4,200 on the S&P year end is the call from Marco Kalanovic and the team over at JP Morgan.
Can't show this enough with the new 5,000 numbers that we're seeing. Joining us now with terrific, rigorous mathematical analysis, Alicia Levine, head of investment strategy, equity advisory solutions, BNY Mellon. I want to talk about Jeffrey Yu's Euro call, but we'll save that for another time. You have a beautiful sentence in your report: cash will underperform. The known worlds in cash. Discuss.
Almost $6 trillion in cash. If you step back and say, what were the trades this year? It was AI, GLP-1s, and cash and T-bills. So the question you say is, if I look into 2024 with an expectation that we're going into a healthy slowdown for the economy, the Fed's going to cut, we think, the second half of the year, not the first half we can discuss, and we have inflation moving in the right direction, where does cash lead you? And it doesn't lead you to the same return you had this year, and this is the time to start reallocating into other assets.
Where does cash go? Individual stocks? Does it go into ETFs? I mean, I'm fascinated within the equity space. Where does BNY Mellon see that the cash will migrate to?
So we think the cash goes to equities. It should be going to bonds, okay? Should be going to bonds, and we're actually calling for a 20% allocation to alternatives as well, because we think this is one of those really...
What's an alternative?
So distressed debt, privates, right? It's a great time for privates, actually, because you're getting the repricing this year into next year, and there's going to be distressed opportunities out there because of the rate hiking cycle. And so that is just a nice setup, and real estate as well, nice setup for an entry of new capital into this asset class.
Before we get stuck into that, just talk to me about cash, how sticky that is at money market funds. When you're making these recommendations to clients, they're jumping on board, still hesitant. What's the tone like?
So clients are receptive to this because with the understanding that what's worked over the last 12 months is likely not to work over the next 12 to 18 months. If you've been in markets long enough, you know that. The same trade doesn't take you far every single year. And on top of that, if we've hit peak rates, we've hit peak Fed, inflation is slowing, cash will underperform the bond market and equities.
Have we seen the distress?
So we haven't seen distress in large cap America. We're going to see it in small cap America and other areas that are reliant on refunding and funding growth. So that means, for instance, the small cap world, that the Russell 2000, 48% are non-earners. They need to borrow to grow. That debt that they're using is floating rate and comes due a lot sooner than the fixed rate debt from the large cap companies that took out loans in 2020 and 2021. So you're setting up a situation where you have some parts of the economy that are relatively insulated, termed out their debt at low rates, like households did with mortgages, and other parts that are more exposed.
Is there any inconsistency in being bullish on risk and also expecting a tick up in distress and bankruptcies?
So there's not an inconsistency because this is not a blanket call, right? The way we've sort of had a rolling recession over the last 12 to 18 months, you're going to get a little bit of that going forward. We do think there's some consolidation in the first half of the year, and actually in an election year when there's an incumbent, there's just a lot of creakiness in the market in the first part of the year as policies get discussed, different sectors are targets. Right, just you tend to have a bit of a slowdown and probably a digestion. We're going to have a year that's up 22 to 23% by the time we finish the year here. So, unlikely that continues in the next few months. It coincides also with if there's a slowdown, it's the first half of the year. Right, because incumbents tend not to like recessions when they're running for re-election.
Is there anything that we could see in less than a half-hour time that could shake your view on this sort of disinflation that allows this next leg of the cycle?
So it's the core, right? So energy prices look to be well tamed. To the discussion earlier that you all had here about the record pumping of oil and gas in the U.S. and also the warm winters everywhere. So oil prices seem to be well contained. If that's the case, the low oil prices will filter into every other sector. So the core prices today at 4%, we'll see what we get in a few minutes' time. That's where you could get a different narrative if it doesn't come down further. But to the point about whether the Fed cuts or not in March, it's just not realistic. And I'll point out in the last 18 months, the market has been overly optimistic on when the Fed has cutting. If you remember, we were talking about the Fed cutting in August of 22. The market has wanted that Fed cut for 18 months now. It's always been too optimistic for where the Fed's going and where reality is going. And if our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
I want to go to your math abilities here. There's a lot of Greek letters getting thrown around right now. Gamma, 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 and the rest of it. Alpha, beta, gamma, epsilon, blah, blah, blah. The skew is silent out there. Explain to our audience the silence that some of these volatility measures show right now.
Boy, 12, a VIX of 12, it's just shocking. But again, the VIX number is really about the volatility in the bond market. And the bond market right now is just well behaved since that CPI report back in early November. So the whole market for the last 18 months has been driven by the bond market, every other asset class. And as long as that is tamed, the VIX as well will be tamed. But look, it's a risk. It means at 12, it's historically very low.
What would you expect from Chairman Powell tomorrow?
I think it's his one chance to push back.
This is it, right?
It's his one chance. So I would expect something like that, because the easing of financial conditions can't be too pleasing for the Fed in their fight. And they will definitely fight back, I think, against that first half rate cut that we're seeing here. I mean, so, you don't want to say, calling victory too early, but he will definitely fight back here.
It's crystal ball type stuff, so forgive me. But do you think the market listens to him anymore? Is that a credible threat, given what we're all seeing in the data?
The data has been very kind to risk assets. So 8:30 today is really the key. More so CPI than Powell, but I expect Powell to push back against all this excitement. And look, the risk in the market is that everybody's expecting a soft landing, right? That's the risk. Where were we all a year ago? Recession.
A year ago, 2 months ago. 2 months ago, TK.
Did she just say we're going to cash? Is that what I heard? Even off inflation?
You ask me that every time, so we are never in cash because.
Okay, there we go.
That's you told.
A domestic to my right, a domestic to my left.
No, but let me just say this. A year ago, you said, so how do you avoid going 5% in cash? And I said, well, we do relative allocations. We never go to cash, and we were over allocated to U.S. large cap. Because if I'm worried about recession, where do I want to be? And that's U.S. large cap. So that was a great allocation for our clients this year.
You wanted to be in the NASDAQ 100 at 48% year to date, which is just absolutely bonkers. That is nuts. Tom, 48% gain on the NASDAQ 100 year to date.
Well, there's that, but there's also the cumulative gain. I'm going to put it 1 year, 2 years together, and I'm sorry, 1977 rings here. You get a bull market next year, the bears are still out of it. There's a huge number of people out of it.
Yeah, blink and you miss it over the last month. Yeah. That's for sure. If you are just joining us, welcome to the program. The S&P 500 shaping up as follows. We look like this. We're positive 0.07%. Yields are lower by 5 basis points, 418.15. Year-to-date gains, Lisa, on the S&P, 20% plus on the S&P 500.
And on the NASDAQ composite, we're looking at 38%. The NASDAQ 100, as you were saying, 48%. These are shocking gains, especially since so many people left the big tech names for dead. What I think is interesting, nobody's willing to say they're not going to invest in big tech or they're going to underweight big tech next year. They'll just broaden out around the margins, but no one is willing to bet against what we saw this year.
Can you bet against the Mag 7, Alicia?
You can trade if you're a trader. Our portfolios are not trading portfolios, but I think it's a mistake. I mean, if you look back since the end of the global financial crisis, go back to 2009, 2010, you had one underperforming year of the Mag 7, and that was in 2022, and that was the regime change year, and we're there. So we got through it. Tech was down 60%. Dance with the one that brought you. You know, tech brought all of us here. So.
All right, 2 items. John Ehrlichman out on Twitter today noting that in 1980 today, Apple stock was issued, and the Commonwealth of Massachusetts Secretary of State decided it was too risky for Massachusetts people to own it. And then the other idea, and Apple, Scott Galloway of NYU saying the single thing he ever did was buy that garbage, and he never sold it.
Never sold it.
Never sold it.
Love that line. Why have I never heard that before? Dance, the one that brought you.
I love that.
That's brilliant. That's just brilliant. Yeah. I love that. Alicia, thank you.
Thank
you. Have a wonderful
all.
Christmas. Thank you so much. From
Merry
New York
and happy.
City. To you as well. CPI just around the corner.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Wednesday, the Fed decides.
We're talking rates. We're talking inflation.
Without a recession. That's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg.
The pressure increases for them to roll these cuts forward through the remainder of the year. Actually, we forecast around 1 million barrel a day surplus for the second quarter and around an overall surplus of about 0.6 million barrels a day through the whole of 2024. So You know, these cuts do need to be maintained to balance the market through the course of next year. They can balance this market and keep this price at $70 to $80 if they work together.
This was the big call from Citi this year. They just did not see triple-digit crude around the corner. That was Max Layton, the global head of commodities research at Citi. Shout out to Ed Morse for that call early this year. Crude looks like this right now on WTI and Brent. I'll give you some of the scores. WTI $70 and about 50 cents. Brent crude 75.17. We're down by a little more than 1% on both of those contracts. Going into inflation data 13 minutes away. Crude supportive, Tom, in the last month of that disinflationary story we're all talking about.
Fascinating to see. We're going to get right to it right now with the schedule that we've got coming up in 12 minutes, this key inflation report. Michael McKee will join us and the set of worthy guests to interpret the many different parts of CPI in America. Right now on oil, Christian Malik joins us, Managing Director, Global Head of Energy Strategy at JP Morgan. On oil, John, we did this yesterday for you. We missed you so much. A gallon of petrol from the peak down 32%. And I guess that's part of the inflation story. Christian, 2 years ago, you were modeling out oil demand led by emerging markets that would put a bid to oil. Is that theory still in place, that EM and developing economies will find a bid, have stable or increasing demand on oil, and lift the price?
If anything, hey, Tom, I think it's strengthened. There is demand in the world that we just simply cannot see. So when we're trying to modeling demand from a scale of 1 to 10, we're going from 7 to 9, there's demand that's negative that's going to be positive. So in other words, there's demand in the EM world, penetration of energy, poverty that we see today, where they would love to consume any form of energy in order to high grade themselves out of poverty, whether it's lights on the street, whether it's being able to get to work. So that demand, that intrinsic demand that is not visible, is so significant that we don't see demand peaking. I don't think we'll see demand peaking in our lifetimes, particularly as EM demand growth continues to surprise the upside.
Which is really counter consensus, considering people were talking about peak demand for quite a while. Christian, let's go through the outlook that you just put out for next year, talking about how prices could stay around here or go a bit lower, as you do have U.S. production reaching all-time records, offsetting some of the cuts. But then what? What happens in the second half?
Right. Well, it's interesting. I think we've had a lot of discussion around these additional barrels that we don't see necessarily coming from the U.S. shale, coming from deep water. And look, credit where it's due, these guys have done a great job in delivering additional productivity and therefore more production. I think the key point that we make from the second half going into next year is that these are all additional barrels. These are tens of thousands of barrels. They're not millions of barrels. There is no massive quantum of volume that we don't know about that's coming into the market over the next 2 to 3 years. And that ultimately means that it's not if, but when does the market tighten, even as we see potential surprises. So I've obviously seen a lot of discussion around surpluses next year, and we can talk about OPEC, but in the end, the biggest acid test, or litmus test, if you like, in terms of when do we know the market's starting to tighten, when OPEC, led by Saudi, adds volume into the market. That's not a negative, that's a positive.
What's been most surprising to you this year, Christian? Because so many people got the call wrong that oil prices would be substantially higher. Why are people so confused by what's going on in crude?
It's a great question. I think there's a couple of reasons. Let's just unpack that. First of all, there's a lot of dark inventory led by Russia, Iran, Venezuela, Libya. That is exactly why this time last year we went bearish. Despite our super cycle call, we went bearish into the first half of this year, simply because there's a lot of volume that we just couldn't see. At least with shale, we can see it. This was inventory that was in excess. So that's the first point in terms of the sort of volatility that we saw. The second is the risk premium, which was introduced through the conflict in the Middle East, where there was concerns around potentially widening of that conflict, and that clearly created a bid to the upside. I don't think the premium's gone away, but it's something we need to keep an eye on. Now, if we're thinking about that in the context of how do we see oil prices going into next year, I think probably the biggest learning curve for us in terms of discovery is the marginal cost for oil. I see a lot of discussion around surpluses and deficits. In some ways, it can be critical. You can make it what you want. The reality is what you can't change is the marginal cost of oil. That has gone up. It's gone up significantly. In fact, if you look at the curve structure in the last 7 years, it's basically moved higher over time. And so why is that relevant? Because if the marginal cost of oil is going up, it's getting more expensive to produce, whether it's because of cash return for the majors, supply chain bottlenecks, etc., then we can look at the time when oil went to $70 in April through the banking crisis and take heed from that. That potentially does start to look like a floor. We're in discovery. I'm not going to try to call that as a hard floor, but that to me sounds like a relevant floor as we think about going into next year in terms of the range. And that's why we've talked about 70 to 90 is the range. It'll be volatile. But let's not forget that the marginal cost of oil is going up, and that typically is the early leading indicator of an upcycle.
This confidence, Christian, that you have goes beyond 2024. You and I have talked about this before. Right. Talk to me about why it is that you can make this call and push it out beyond 24 into 25.
There is no significant volume of oil coming to the market in the next into the rest of the decade. All the volume that we know, we can see. If there's additional upside, fair enough, that could create volatility to oil, but there's no major quantum, not like the North Sea in the 80s, not like shale in the last 10 to 12 years. And so with that in mind, it's just a matter of time before the market significantly tightens. And as the market tightens, we expect the second half of the decade, we'll see severe tightening. That is the point where the only real quantum of volume that we can rely on and lean into is OPEC. So when people tell me, oh, OPEC is cutting, it's a bit like the 80s, they're getting weaker, I sort of reverse this and think almost like the art of war here. They're retreating in order to advance. They're going to take share of demand growth in the future when all the big volume out there has diminished. And again, I've stressed big because I'm not saying that we won't see more volume, but not in the millions of barrels that we need to meet that future demand growth, which is at least going to be between 107 and 108 million barrels by 2030, if not higher.
What's the signal that you take from the consolidation that we've seen on the US side of things in places like the Permian?
Yeah, it tells me two things. One, that these companies now struggling to significantly raise productivity on the land they own. So they're having to now pay a premium using paper to gain more land in order to take productivity and efficiencies that they've got, apply it to the land that they've acquired and raised. So this is definitely a narrative of efficiency. It's a narrative of increased productivity, but it's sort of a double-edged sword. It's telling you that they don't have it themselves in their own portfolio. They're sort of maxed out on productivity, which is clearly bullish, but equally that means that there's more wood to chop on what they bought in terms of the acreage to raise the productivity to the standard that they're on, for example, Exxon. So while that means we'll see potentially more volume hit the market over the next 2 to 3 years, I wouldn't underestimate the productivity gains. It feels to me as a short duration call to the upside, because what these deals are telling you is that beyond 25, 26, we're now seeing a significant reduction in new inventory that can hit the market. And therefore, I'm not necessarily going to call a peak on shale. Shale will continue to grow. We actually need shale. We don't want prices going very quickly to 150, but shale as a sort of as a basin that's going to grow every year by $1.5 million based on where the oil price. I think those days are over. Now we're sort of in steady state, and we'll see additional volume, but not significant.
Hey, Christian, you're one of the best. Appreciate it, as always. Christian Malek of JP Morgan on this oil market. Just an update from Harvard University, Lisa, just moments ago, this crossing on Twitter from the Harvard Corporation. In this tumultuous and difficult time, we unanimously stand in support of President Gay. That tweet, that post just dropping on X moments ago.
And it comes after the Crimson, the Harvard newspaper, came out and said that Claudine Gay would remain as president, with 700, I believe, academics supporting her, signing a letter of support. What this does going forward in terms of changes to the policies still is an open question as people look to chart a new path.
Yeah, the pressure, Tom, the pushback against this isn't going to go away.
It seems to be school by school, too. It seems to be each school has a different tack, a different emotion, a different culture.
And that's the latest on Harvard and the college education system here in America. Let's get you up to speed on what is still to come this morning. 4 minutes away from a CPI report in the United States of America. Mike McKee is going to give you a preview in just a moment. In the next hour on Bloomberg TV, we'll catch up with Victoria Fernandez of Crossmark, David Leibovitz of JP Morgan, Troy Gajewski of FS Investments to take you into TK, the opening bell, about an hour from now.
We welcome all of you on Bloomberg Television and Bloomberg Radio here to an inflation report in 3 minutes. Michael McKee joins us now, international economics and inflation correspondent. He's in charge of the inflation countdown clock. Michael McKee, the Bureau of Labor Statistics says they look at 80,000 items for inflation. I think our audience has an understanding of the predictability of jobs, of ADP, even of claims. Is it easy to predict inflation?
It's actually reasonably easy to predict inflation within the contours of what that means. But analysts are generally pretty close to right on when it comes to the inflation forecasts. Prices don't change that much that often, and a lot of them are very visible. So it's not too hard for them to plug these numbers into a computer and come up with a model ID. So yeah, we should see something along the lines of what's forecast for today.
On those 80,000 items, Michael McKee, what is the weighting of rent and food, the things we actually spend money on, housing?
Well, rent is over 30% of the index in the CPI, so that's a really big one. It's been coming down. The question is, how fast does it come down? It's been coming down slower than people anticipate. Food also big, and there is a feeling that we may see a bit of a rise in food prices for the month of November, which might be a disappointment to those who were thinking food and gasoline coming down makes the consumer happier. Gasoline prices will be the story today, though, down 6% during the month. But if food prices rise a little bit, that adds a little twist too.
What are the whisper numbers, Michael? We know that we have whisper non-farm payrolls. Are there sort of whisper numbers for the CPI as people sort of ratchet around with recent data?
We don't have a specific whisper number, but the lean on Wall Street is to perhaps a slightly lower CPI than we're anticipating. A higher one would certainly have an impact on the markets as bonds repriced. A lower one might have more of an impact on the futures markets in terms of what the Fed is going to do.
On a correlated basis, John, I would suggest the markets are already celebrating as a small, but it's tangible lift to the markets. Futures up 9 and yields come in nicely.
I think that's the whisper. That is it.
That's the whisper.
There.
I'm looking at it
for
on the
many
Bloomberg.
People, Lisa, this kind of blasé attitude has taken over with inflation with regards to how markets have traded over the last month.
We've seen disinflation, and we've seen more of it than people have expected time and again, and it's international. And we keep talking about that with the ECB and the euro and where it is versus the dollar. But also in the UK, we saw wages. Wage growth came in a little bit lower than expected earlier this morning. So people are kind of leaning into that. How big of a surprise to the upside would it take to disrupt this narrative?
It'd have to be a big one, wouldn't it?
It would have to be big.
It really would. So this is what it looks like the next couple of days. In just a moment, in about 30 seconds, you're going to get CPI data in America. Then on to tomorrow, a Federal Reserve decision. After that, retail sales. And then for many of you, Europa. Before we get there, let's get to the equity market on the S&P 500. The scores look like this on the S&P going into this print. Equity futures positive here by 0.2% on the S&P 500. Just a little bit of a lift in the equity market. In the bond market, bid, massive rally over the last month. Yields lower by 6 basis points on a 10-year to 4.1681. The inflation data just around the corner with a 2-year at 4.66 and down about 4 basis points on the session. With your economic data, here's Mike McKee.
Well, we come in a little bit higher, John, on the CPI headline, up 0.1%. The forecast was for a flat reading, and that's what we'd had the month before. However, base effects come into play, and so we do see a decline in the year-over-year headline to 3.1% from 3.2%. As far as the core, it is what was forecast, 0.3, a slight tick up from last month's 0.2 gain, and so that leaves us at 4% for the month of November on a year-over-year basis, again, what was forecast. So some progress as we go forward with these inflation numbers, but that last mile proving slow for the Fed.
Knee-jerk reaction in line as a beat. Nothing to change the story. Equities march on, up 0.25% on the S&P 500. In the bond market, the rally continues. Yields lower on a 10-year by 7 basis points, 4.16 on a 2-year, down 5. Session lows at about 4.65 on a 2-year. In the FX market, just a touch more dollar weakness in there against G10 and against the euro. The euro just off session highs of 108.15, largely in line away from the headline figure, Bramo, and the takeaway for so many is, okay, carry on.
This, to me, is markets looking for a reason to keep on partying. Basically, the Fed pivot party that we were hearing about from Emily Rowland, this just sort of, you can lean into it across the board, even though a slight headline beat. The tail risk is off the table, that potentially we could see a reacceleration of inflation ahead of this meeting tomorrow.
Into the Fed. Mike McKee, let's talk about it. Chairman Powell's statement, projections, news conference. What's the guidebook, the playbook, Mike, for you and the team?
Well, he's going to look at these numbers and have a pretty good reason for saying we have made progress, but we're not there yet, so we're going to keep the option open to raise rates in the future. But they're not going to put any timetable on that, and they'll put off any discussion of whether or not they're going to cut rates, because he'll say it's too early for that. I do have some good news here in the breakdown of this. Food prices did not accelerate. They actually dropped a little bit, 0.2 gain for the month for overall food prices, down from 3, and food at home drops to a 0.1 increase from a 0.3 increase. So if you go to the grocery store, prices are a little bit more contained. Gasoline prices, as we anticipated, down 6%. That's the big drag on the overall number. Interesting, though, electricity is up 1.4%. From a 0.3 gain the month before, and I wonder if that's because we go off daylight saving time and people are turning the lights on sooner. Used cars do drop a little bit. Actually, used cars go up, which is what was anticipated, 1.6%. A legacy of the UAW strike. There weren't new cars, so more demand for used cars. New car prices were down 0.1%, and that'll probably reverse. And then apparel. This was one of the areas that Wall Street was looking at for a drop, and it comes in as a 0.3 drop, 1.3% drop on the month. So maybe a little bit of a bonus for people who are looking for Christmas holiday gifts. And then in terms of shelter costs, they were up by 0.4 during the month. That's up a little bit from 0.3, so not exactly as good as the market had hoped.
What we're seeing also is that real wages are going up, and the average hourly earnings and average weekly earnings are increasing. When is this too good news to be true for the longer term? When does this become something that fuels spending? How long can we continue to see immaculate disinflation, which is yet again what we're seeing in this report?
Well, remember, these are based on wage percentages from the prior month, so it doesn't suggest necessarily that we're getting way out of line. 0.8 is better than most months, but it's still the same as we saw the prior month. Now, the weekly earnings were up 0.5%, better than decline that we saw of 0.1 in the prior month. So it probably keeps people spending money. We know that people tend to spend what they earn. And it's less about bonuses and less about government aid. It's more about what your paycheck shows. And so if people are seeing their money goes farther, then maybe they're continuing to spend money. We'll see on Thursday about that.
Mike McKee, thank you, sir. Always great to get the breakdown from you on the economic data. Mike McKee there breaking down CPI. Here's the breakdown of the price action. Equities fade just a touch. Still positive by 0.1% on the S&P 500. Nothing in this, though, Tom, to change your mind. Whatever you thought yesterday, there's nothing here to change your mind from that.
I'm looking at the micro moves here, John, and I think that's correct. We did see a beneficial spike down indicating more disinflation, but critically we did not go through, depending on the series, support or resistance levels of 5, 6, 8 days ago. We didn't see the 10-year real yield break down under where it was in the celebration of December 6 and December 7. So guess what? We await more data, and I believe in the next 48 hours we get more data.
Retail sales on Thursday, and then it's on to the Federal Reserve, Tom, tomorrow before that.
Yeah, we'll have to see just off those meetings as well. What we have is a lift in the market. The levels are so important, and we haven't really done that today. 46.81, Standard & Poor's 500, Dow 36,900, knocking on 37,000. The NASDAQ 100, 16,470 is a shocking number. John mentioning up 40% for the year there. I think that's a bull market. Dana Peterson knows a bull market when she sees it. Chief economist at the conference board with wonderful perception on the American consumer. Dana, how do you link a quiescent inflation report like this over to retail sales on Thursday?
Well, I think the key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects. But as was mentioned earlier, real wages are rising, and certainly it's supporting consumer spending. But when we ask consumers how they feel, they're still complaining about inflation. They're still saying that everything's too expensive. Interest rates are rising, so that means if you wanted to buy that car or refrigerator, it's going to cost more. So I would expect that even though real wages are rising, inflation is still there, and consumers are probably going to start pulling back on spending.
How are real wages doing? And within that, are they part, I mean, is it almost circuitous where they're actually part of the inflation report as we adjust for inflation with wages?
Well, I think wages are a part of the inflation story. Certainly, you have a number of industries that are experiencing labor shortages. And when you look at their wages, nominal and real, they're still rising pretty quickly. And I think that's showing up in the services aspect. Let's also not forget that insurance costs are rising because many of these insurance companies are suffering losses and they're raising premiums. So between insurance and wages, we still have these sticky inflation measures. And I don't think that's going to go away right away.
So, Dana, do you think that people are a little bit overzealous about this idea that the Fed is going to cut rates significantly next year?
I think they are. Indeed, the Fed tomorrow is probably going to signal, yes, it's done, but don't expect rate cuts anytime soon, and don't expect that many next year. We think anywhere from 50 to 100 basis points probably makes sense, especially if inflation, according to the SEP, doesn't get beyond 2% before the end of next year. So I still think that, yes, we can get to 2% by the end of next year, but that's really going to suggest that not many interest rate cuts are priced in.
Was transitory right, Dana? Are we just basically seeing the right sizing of the supply side after the pandemic, and that's entirely what we're seeing now? Or is this disinflation transitory? Is this basically a period of a head fake before some of the stickier elements take place in a more significant way?
Well, I don't know why people are surprised that inflation gauges are slowing. The Fed did raise rates by 525 basis points. This is part of the program. Certainly, we saw the housing market slow first, and that's showing up with a significant lag in the rental components of the CPI and the PCE deflator. So that's slowing things down. Certainly, food and energy prices are determined by things external, and we don't have the massive disruptions from OPEC or even wars affecting energy prices, so they're coming off. But you still have the influence of insurance costs and wages because labor shortages are here. And I think that's going to be, those two things are going to be the challenge to getting inflation back to 2%. But we can still get there.
Dana Peterson, well, this is the conference board. Dana, please stay with us. We're going to come right back. A market check here because you saw a spike, whichever way your series going, and we sort of given it back. S&P futures had a nice pop. They've given it back up 6 right now. Same thing in the yield space. The 10-year yield 4.21%. I noticed the real yield was 197. Has come back nicely, 2.01. Perhaps we're already on the way to adjusting for the Fed meeting tomorrow. Dana Peterson, what is nominal GDP? How about Chairman Powell? He watches every morning. What's your estimate here of the animal spirit of Chairman Powell's America?
Well, I think, nominal GDP is certainly, nominal and real GDP are probably not going to be as strong as what we saw in the third quarter. We're probably looking at growth around, 1% in real terms and roughly 4% in nominal terms, right? Adding in, roughly 3% headline inflation. So that's a slowing economy. And I think, again, that's part of the program. The Fed wants to see the economy slow to help bring down inflation. Now, when we look at business investment, that's already slowing outside of manufacturing, where companies are bringing back product and production and they're building factories. Away from that, there's really not that much investment. The last shoe to drop has to be the consumer. And we know consumers are more indebted now. Their interest rates on their credit cards are higher. Student loan payments are coming back. And, consumers are quitting less and they're thinking, well, maybe the labor market's going to slow, so maybe I should also slow my spending as well.
Dana, I'm just curious. We're seeing that shelter prices pretty much offset the decline from oil prices. Is that sustainable, or do you think that this is just sort of a lag before we start to see housing costs inflect downward?
Well, I don't really look at the month-on-month for housing. I look at the year-on-year. And year-on-year, the rental components are slowing, and it's consistent with an 18-month lag of the Case-Shiller Home Price Index. So we're seeing this happen. Month to month, you're going to have bumpiness, but it's a year-on-year growth rate or rate of inflation that we should be paying attention to in terms of what's driving headline and core inflation in the PCE deflator.
Dana Peterson, thank you for the brief with the conference board and onto the Fed tomorrow in retail sales. Always important at the conference board on Thursday. In the markets, there's any number of ways to go here. We've got futures. They ebb back. We had the spike up, the big move, Lisa. We come back. Dollar fractionally weaker as well. There is a pulse to the market. I don't want to underplay it. But certainly we did not get the drama of a CPI report as some expected.
We didn't get the tail risk, which was an upside surprise, particularly in core. It was in line, and that was enough to set this sort of pivot party on its trajectory upward. I just do want to say, yesterday the S&P closed at the highest level in 20 months. I mean, we're talking about a real kind of momentum that this doesn't lean against in any way.
And I don't see the exuberance. And the note was made that the total return index, this is throwing in dividends and all that, of the Dow's a record high, and SPX is T-Sweet's 1% away as well. Right now, futures up to fractional, up 0.1%.
And now it's over to Fed Chair Jay Powell. What does he do with this? Does he basically say that this shows progress, but there's clearly more to do and be promptly ignored? Or will he say there has been a real easing in financial conditions and we're concerned that this could actually work against the progress that we're seeing? That could potentially shift things a little bit.
Well, I think it can shift things. What's so impressive to me is it was, a Midland report. Does he come out with a Midland press conference? What is the... If it's not a snooze fest or a non-event, but if he doesn't give a tendency, isn't that just more ambiguity into the end of the year?
If he does not push back actively against the sort of easing in financial conditions, the rally that we've seen in stocks and bonds, that will be viewed as the starting gun to an even greater rally because people will say, all right, let's go. There's no reason why he'll push back now.
This is fun. Thanks to Mike McKee for his leadership. He'll be with us, of course, tomorrow and under retail sales. On Thursday as well, our leadership will be about the equity markets. Coming up, Gina Martin-Adams, she was brilliant on the real economy, the misunderestimation of how corporations adapt. And Ira Jersey will join us, these two wonderful guests, to give you perspective. Here, futures up 9, they come back flat. Futures right now. Unch is what the pro say. Unch is for unchanged, Lisa. Thank you. You nailed that.
Fantastic.
Unch, the VIX 12.42. From New York on radio and television, Bloomberg surveillance. Stay with us.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of, 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
earnings recession has largely happened. We've had rolling industry recessions. I don't think even if it's in a slower growth environment from an economic perspective, we're likely to see another big hit to earnings. I don't expect to see the Magnificent Seven crater in 2024. I believe that stocks can outperform and will outperform cash in 2024.
That was Kate Moore, head of thematic strategy of BlackRock, yesterday, leading into this idea of stocks outperforming in 2024. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramos, John Zoff, preparing for the open. We did just get CPI. It came in pretty much in line with expectations. Markets bouncing around, retracing some of what we just saw, Tom, given the fact that people are parsing below the surface, realizing that, okay, it was pretty much in line, but there were some things like used car prices and shelter that surprised a bit to the upside.
Right on the screen right now, we were up 9, I think, at the peak here, a celebration of CPI, and there's some new analysis. And frankly, I would suggest people have leapt right onto the Fed meeting as well. We'll talk to two worthy guests here in a moment. Can I give you a mover?
Yeah, please.
From long ago and far away. Amy, give me this banner. I think it's so important. What a delicate interview you and I had with John in London with Kathy Wood of ARC. And she has surged off our London visit up 37% since our London sojourn. And that's an example. You know, it's not Magnificent Seven. She's in a lot of other stuff and some tech unprofitables. But that's the, not whiplash, but just the surge we've seen in this new, now SPX near record high.
Yeah, it's the everything rally fueled by the disinflation narrative and the sort of soft landing hopes and dream that are becoming increasingly reality. I do want to just bring this to you from Neil Dutta over at Renaissance Macro, saying core inflation did come in line with expectations despite a 1.6% increase in used car and truck prices. That's unlikely to persist in the coming months. Room for downside on core inflation ahead, maybe fueling some of the hopes that have been baked into the market. Joining us now, Ira Jersey, Chief U.S. strategist on interest rates for Bloomberg Intelligence. What do you take just in terms of both the actual report and the market reaction, Ira?
Yeah, so I think the market reaction was just that the data wasn't much weaker than expected. You know, going into this, we had some weak data out of Europe overnight. We had weak wage data in the UK. So you saw kind of an everything government bond rally going into the number. And then the number came out and then, you know, was kind of meh, you know, pretty much as expected. You know, some of the details are interesting, but I don't think it's really going to move the Fed. But I think the impetus for the Fed to be more dovish tomorrow because of this is off the table. And that's why you've seen like TIPS yields, as Tom was mentioning, real yields were under 2% in the 10-year space. Now they're a little bit above 2%. And I think that people are just setting up to be flat going into tomorrow's FOMC meeting.
Where's an appropriate real yield, Ira Jersey? I've heard 1.5. I've also heard 2.1, 2.2%. Where do you think is a efficacious inflation-adjusted yield for the chairman?
Yeah, well, I think he would probably like to have it somewhere between 1.5 and 2%, and you know, obviously we're pretty close to there. I think the thing for the market and what the market's going to be pricing is, you know, is the Federal Reserve going to be able to cut to below 4%? Because right now we're pricing for the terminal target rate for the Fed funds to be during the next cycle 4%. If it's going to be below that, then you can certainly see 10-year real yields down toward one and you know, maybe even under 1% by the time we get to you know, the trough in the Fed funds rate in the next cycle.
Is your space, Ira Jersey, driving the stock market? Are you driving the space that Gina Martin Adams lives in?
Well, I'll let Gina talk about that, but it certainly seems that on many days, you know, in particular, I think when interest rates are moving higher, I think that is a headwind to risk asset markets. So on a lot of days when you see, you know, interest rates up by 10, 15, 20 basis points, you definitely see weakness, you know, throughout the entire risk complex. Part of this, I think, is just the idea that you know, all markets are almost correlated now, and that's a symptom, I think, of what central banks have done with their balance sheet, with QE, with quantitative tightening now, where it's you know, that when treasury prices are down, stock prices might be down as well.
So real volatility are red on the screen and now up fractionally up 1 point. Dow up 68 points, a VIX 12.42. Ira Jersey, thank you so much. She was absolutely brilliant the last time she was on. Gina Martin Adams drives all of our equity strategy at Bloomberg Intelligence. Gina, I want to go right back to your insight the last time around. How is the real economy, revenues and earnings, and a buoyant stock market reacting to all this fixed income chat?
Well, I think that the market reaction this year tells you everything you need to know. Large caps are rallying even though yields have risen this year. And that's because earnings have recovered after the recession that they went through in 2022. So when we look at the outlook for next year, I don't think it's all about rates. I think rates are a component of what moves equity markets and certainly do impact valuations. But ultimately, the outcomes of 2024 will probably be determined by the degree to which companies can surprise on the upside. Very, very low earnings expectations. The market narrative still is the U.S. economy is flirting with, if not maybe going to fall into recession. And yet the corporate earnings stream continues to recover, posting relatively solid growth in the third quarter, expected to show acceleration in growth throughout the year ahead. This is certainly going to take the market by surprise if it does happen. If the consensus of analysts is correct, that's not in the price. What is in the price, though, is what the bond market is telling us with respect to rates. So we could see if the bond market is wrong and the Fed is not going to reduce interest rates to any degree next year, or even to the degree expected by the bond market, that certainly could impact the equity market. But I think that earnings are also important.
Gina, just to sort of develop that a little bit more, are you saying that a lot of these inflation reads, even retail sales, a lot of stock investors are going to be looking more for the tail risks, more for confirmation that there isn't some either extraordinary weakness or extraordinary inflationary bend to just get even more bullish, right? Basically, the idea of what isn't happening, get it confirmed, and then keep going.
Yeah, I do think that the trouble that we have in the market right now is that for 2 years we've been talking about this weakness. And so the equity market has been conditioned and trained to expect persistent weakness in the economy with some inflation pressure, and the Fed therefore responding to inflation. And anything that is contrary to that sort of central set of the narrative is going to move the equity market. So I think you're spot on, Lisa. It really is about where are expect to those expectations, and then any shocks to those expectations do move the needle.
Gina, give me the breadth update here. You've had a home run this year in terms of, hey, folks, you got to be in the market. All that cash is out there. Alicia Levine at BNY Mellon says, stop with the cash. Get into the market. What's the breadth going to look like?
Well, look, I think that this is a little bit of an overdone story. Certainly the Magnificent Seven have had the strongest gains in the S&P 500, and because they are the biggest market cap components of the S&P 500, a lot of the gains in the index are attributed to these stocks. But we're sitting in a situation where roughly 65% of the stocks on the S&P 500 are trading above their 200-day moving average. So we've got plenty of participation in this market. Where we need to see more participation is really in the small cap index. This has been an anomaly, and certainly very contrary to historical experience. You very rarely see large caps rip like this with pretty strong participation. Even if leadership is concentrated, participation is very firm. And we're not seeing that in small caps yet. So what I would expect to see in 2024, if our theory of a broadening recovery sort of plays out into next year, is small caps should start to participate. And that certainly will take the entire consensus narrative by surprise.
Gina Martin Adams, thank you so much. Ira Jersey, thank you so much to all our guests today as we looked at a interesting, I'm going to call it an inflation report of stability is, well, Lisa, not a small issue, but before we hear from Chairman Powell, we have to look at industrial business inflation. The world used to stop 30 years ago. PPI was more important than CPI.
Yeah.
And I'm not going to say that now, but nevertheless, there are those numbers with a disinflationary trend. PPI, X food, energy, trade, the Dodgers, Ohtani deal, X all that, 2.9% down to 2.8%.
And the gap between PPI and CPI gives you a sense of what some of those margins might look like in corporate America, to Gina Martin Adams' point.
Well said.
Right?
Yeah.
I mean, basically,
Huge
this
deal.
is how much can stores keep marking up prices despite the fact that their prices are going down. And if they can keep increasing the price, what does that tell you about the strength of the consumer?
The market churning here. I mean, there's no other way to put it. I got a true red and green on the screen. Tape, the VIX 12.46. I don't know what to do with the VIX. Alicia was dead on about that. Yields, where were we? In 6 basis points, in 9 basis points. Yields now flat. I got a 2-year yield fractionally higher, 4.73%. What I would do, I would stay with Bloomberg Radio and Bloomberg Television through the day. in nuance in different markets, and of course to the Fed meeting tomorrow. From PGIM, David Hunt, their president, at 3:30 this afternoon.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Live from New York City this morning. Good morning, good morning. The CPI report is behind us. Chairman Powell still ahead. Your equity market just a touch softer on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, coming up, Chair Powell gets a no-drama inflation report. Weak holiday sales are hitting Hasbro hard, and Ford delivers EV hopes a reality check. We begin with the big issue, inflation in America.
We have CPI data.
Inflation data.
Inflation numbers.
Inflation's been coming down very gradually.
We've seen inflation start to trend lower.
To slow down inflation.
I think all the factors that were there to bring inflation down, they're still there.
We still have a lot of disinflationary forces.
Underlying trends for inflation are extremely favorable. All the way down to 2%. We think that's going to be a hard pull. Kind of the easy disinflation is behind us. We don't think the Fed is going to blink. even if inflation does continue to slow.
The Fed needs to ensure that inflation is stamped out.
That's the big bet right now. Can the Fed afford to pull back?
What's the speed of that disinflation that they can live with, and what's still not fast enough?
We're going to have a Fed meeting that's critical.
We'll be looking at the Fed for clues at their meeting this week.
Let's have that conversation right now. JP Morgan's David Leibovitz, Crossmark's Victoria Fernandez. Fernandez, let's get to you first. Victoria, the CPI report of 31 minutes ago. Your thoughts on it?
Yeah, I don't think there was a big surprise in this report, except for some of the things that were maybe a little stickier than what people anticipated. You had the shelter number, which a lot of people thought was going to come down pretty significantly, actually moved up a little bit. Headline brought down, obviously, by gasoline prices, down 6%, so that pulled the headline down. But I think the key thing that Powell and the Fed is going to be watching is that core number did not move. We're still at 4%. So the market and investors that have that belief that inflation is going to continue to fall rapidly and that the Fed is therefore going to start cutting rates, I think this might be a little bit of an eye-opener to say, wait a minute, maybe we need to take a step back. Maybe we need to think that the Fed probably will be higher for longer, and I'll actually be looking for Powell tomorrow to push back a little bit on where the market is, where it's gotten a little bit ahead of itself. I think this inflation report feeds into that narrative.
David, let's go there. What's the risk we get stuck at 4?
So, when we look at what's happening in the core figures themselves, obviously headline was driven by what happened with gasoline. But, the BLS even said in the report that 70% of the core inflation that we're seeing is still attributable to housing. And so when we look at what's going on there, we look at some of the more timely measures, the Zillow measure, the Cleveland Fed measure. If you run some simple analysis and kind of use various leads and lags, it does suggest that shelter component should come off the boil over the course of the next few months. It's not going to happen instantaneously. That should help bring us down a bit further, but I do think that we still need to respect the fact that the last mile of the inflation journey is often the most difficult, and getting a Fed that's cutting in May does feel like a bit of a stretch from where I sit right now.
This is the constructive view. It comes from Neil Dutta of Renaissance Macro, just getting our teeth into the data. He says this: core inflation came in line with expectations despite a 1.6% increase in used car and truck prices. Goes on to say that's unlikely to persist in the coming months. There's room for downside on core inflation ahead. Victoria, would you push back against that?
I push back a little bit, even though I really like what Neil usually says. Not because I think that used car prices aren't going to come down. They probably will. They're actually quite volatile. We saw them down the month before. We saw them up this time. But I just think that it's going to be much tougher to take that core number lower at the pace that the market anticipates it's going to be. So I would push back on the idea that this core inflation is going to come down and that's going to be a green light for the Fed to go ahead and cut rates. There's a lot of elements in there, and we know that the housing market has been stuck a little bit. We've seen housing prices go higher, which is going to feed in to a higher shelter component, and we know that it's going to take a little bit of time for those numbers to start coming down. So I don't think that there's an imminent decrease in that number. I think we're going to have to wait quite a few months to see that, and that fits right into that higher for longer on the rates.
26 minutes away from the up and about. Futures pulling in just a touch on the S&P. We're down about 0.1% on the S&P 500. Originally off the back of the move about 34 minutes ago, equities were a little bit higher. That's faded just since. Getting deeper into the inflation report, let's catch up with Mike McKee. Hey, Mike.
Hey, John. Well, this is basically a status quo inflation report. It is a little bit higher on the headline number, but the year-over-year numbers come down as anticipated, and the Fed is basically where it thought it would be, with a 3.1% headline rate and a 4% core rate. Housing, as you've mentioned, and used cars were the big customers for price increases. Decreasing gasoline, that really pushed things down, and apparel prices, a bit of a surprise. The super core, which Jay Powell had made his sort of favorite indicator, has kind of dropped off their list, and maybe that's good news, because we take out housing here and we still see core prices going up for the month by more than double what they had the prior month, and on a year-over-year basis, up to 3.93%. It was in the twos before. And then we want to take a look at the breakdown overall of where prices have gone, and it's still services that we're worried about. You look at the ECAN function on the Bloomberg, our quant-driven analysis of what's happened in any economic indicator, and services, the yellow, is really the big mover here. Goods prices are the blue ones, and as you can see, they're up a little bit, but not a whole lot, and energy prices obviously significantly lower. So this is basically, as I said, an as-expected report. We're waiting for services to come down more, driven a lot by housing, but also there are other aspects of that core that the Fed's going to keep an eye on. It's been said, the last mile, John, is the hardest for them.
And that might be still ahead of us. Mike McKee, thank you, sir. Mike McKee on the latest inflation data. David Leibovitz, let's talk about it. The data's in. Chairman Powell is tomorrow. Where does it leave him in the committee?
So I think that the Fed is likely a bit uncomfortable with where the market is currently priced. And if you look at whether it's the super core measure or you isolate, restaurant prices and what's been happening there, you're still seeing things go up at a pace that I think makes the Fed uncomfortable. I think that the tone tomorrow is going to be more balanced than it's been in the past. I think that they're going to begin to view kind of the risks as being more two-sided, to use a bit of Fed speak. But I think that they're going to push back again against what the market is pricing, which is a cut, in the late spring and early summer. By our lights, the Fed is probably going to remain on hold at least until the third quarter of next year. And again, I think that they want to see more progress on core inflation and even that super core measure before they begin to signal easier policy, because we've seen this trade play out time and time again. The market gets a whiff that the Fed may ease, and all of a sudden financial conditions loosen. The Fed is trying to avoid that, and I think they're going to be very careful in their messaging to try to prevent it from happening again.
So, Victoria, let's say we get all of that. We get a hawkish hold from this Federal Reserve. This market is not listening. It's moved on. Any reason why it starts to listen tomorrow?
I'm not sure what it's going to take for the market to really listen to what Powell's saying. The message hasn't changed, but they're getting kind of this confirmation bias is what the market's doing. They have Waller saying, look, if inflation comes down, we can cut rates, and they grasp onto that, and they're really running with it. I think the dot plots could be something that helps push against the market. I mean, I anticipate that we'll probably see the year-end rate for 2024 come down maybe 50 basis points. It was at, 5.1? Maybe it comes down to around 4.6. That's very different than where the market was pricing it about 4 or 5 weeks ago. It was at 4%. Now I think the market's pricing it around a 4.30. So maybe that starts to shift the market, but they have to come to terms with the belief that you can't have earnings expectations of 11%, revenue expectations of 5% growth, and still think the Fed is going to come in and cut by 100 or 125 basis points next year. They don't fit together. So at some point, the market's going to have to determine which one of those beliefs they no longer believe in.
Well, David, let's just say right now, I believe that we get 100 basis points plus of cuts next year, and then the Federal Reserve comes out and moves in my direction, doesn't go all the way, but moves in my direction and prices in 3, projects 3, implies 3 based on their 2024 median dot. Is that sufficient, David, to validate what's been priced over the last month?
So I think that if we get that type of messaging from the Fed, it at a minimum is moving in the direction that the market would like to see. One of the things that we've been talking about quite a bit with respect to Fed cuts and the cuts being priced into the market is, does the overall level of cuts priced in change, or does the timing of those cuts simply shift? And I think if we get a message from the Fed that the timing of those cuts is simply going to shift, but there is still 3, maybe 4 cuts in the cards over, say, the course of the next 18 months, right? The market can deal with that, and I think it'll deal with that pretty well. What is going to give the market indigestion is if the Fed sends a hawkish signal that we aren't going to get those 3 to 4 cuts over the course of the next year to year and a half. And so I think again, the dot plot, that's a very good point that Victoria makes. Watching the dot plot is going to be key with respect to 2024, but also with respect to 2025.
Well, let's get beyond tomorrow and focus on the next 12 months. The calls coming in from Citi on the S&P 500, 5,100. Oppenheimer, they're going higher, 5,200 on the S&P 500 year-end next year. Victoria, we've had a massive move over the last month, and we're starting to see signs of improving breadth as well going into next year. Do you see reason to believe that the path of least resistance is still higher?
I think in the short term, Jonathan, yes, because of the things you mentioned. The breadth is there. We've seen the percentage of S&P stocks above their 200-day or above their 20-day moving averages. That's gone higher. You've seen small caps start to do a little bit better and participate, and you've seen that Magnificent Seven actually start to come back, which I think is positive for the market because it allows the equal weight to catch up. So I think in the short term, yes, because the seasonality works for you as well here too. But there are so many things that are telling us on a little bit longer term, the volatility is going to be there. I mean, Jonathan, look, you have things that typically have very high correlations, like the economic surprise index and discretionary versus staples ratio. Those are going in opposite directions right now, which is not typical. You have positioning. We were oversold. Now we're overbought. That can change. And I think you are going to have a repricing in the market where yields are going to go back higher as some of these early rate cuts are going to get priced out of the market. So for a short term, yes, I think you could be tactical and you can make some moves here. But I think as we look out into the first half of next year and the second half of next year, you have to be a little bit more cautious. I think that's when we're going to see some of the pullbacks come into play.
David, do you agree?
I would generally agree with that. I'd go back to the point I was making earlier about the number of cuts versus the timing, and I very much would expect that yields will back up as we get more clarity about when the Fed will or perhaps will not be hiking. But I do get the sense that equities may be able to take that in stride. I mean, the growth backdrop remains relatively supportive. Earnings estimates look fairly decent for next year. I would fade the consensus numbers a bit, but we're still getting kind of mid-single digits for S&P 500 earnings over the course of 2024. And I think as long as that growth narrative remains in play, equities can stomach higher interest rates. It's if we begin to see cracks in the labor market or in the economy more broadly, that I think we'll see a meaningful pullback in risk. But would agree with the point on higher yields, maybe a little bit more constructive on equities looking forward.
More still to come in this conversation. David Leibovitz, Victoria Fernandez, about 20 minutes out from the opening bell. Equities negative by just 0.03%. Will Chairman Powell push back, and how will this market respond to it? We need to figure all of that out in the next 24 hours. Let's get you some movers going into the open. Here's Abby.
Beneath that fairly benign surface for stocks, John, we have some bigger movers beneath going to the downside, starting out with the shares of Oracle. The worst day since March of 2016, headed toward that worst day, down 9.5%. This, of course, is revenues of $12.94 billion. Missed estimates by about 1%. Cloud growth was disappointing at 25% versus 30% in the previous quarter. For a stock up 40% into the print, it just wasn't good enough. Airbnb down 2.6% as the stock is cut to an underweight at Barclays. A team of analysts there saying that short-term demand is slowing as competitive pressures stack up from hotels. And then finally, Alphabet heading to a second down day in a row. They lost their lawsuit filed by Epic Games. A San Francisco jury sided with Epic in less than 4 hours that Alphabet overstepped its powers relative to its App Store. Well, that's threatening $200 billion of App Store revenue in that duopoly with Apple.
Abby, thank you. More from Abigail around the opening bell. Coming up on this program, Hasbro cutting 20% of its workforce.
We have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace.
Corporate America tightening its belt ahead of the holidays. That conversation up next.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. And I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The Fed can take responsibility for the improvement that we've seen on the demand side, certainly not the supply side, not the good side of things, as you talk about the recalibration in the aftermath of reopening the global economy. But on the demand side, we have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace.
Slumping holiday sales leading to a second round of job cuts at Hasbro. The toy maker cutting close to 20% of its staff over the next 18 to 24 months. The quote from the CEO, market headwinds we anticipated have proven to be stronger and more persistent than planned. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, we're talking about Hasbro here. It's the maker of Dungeons & Dragons, My Little Pony. I'm sure you're familiar. It's really been struggling post-pandemic. You're seeing those struggles continue now today. So these planned job cuts are going to take place over the next 18 to 24 months. They include 200 jobs that were left over from a previous round of job cuts. That's expected to cost $134 million or so up front and then save $100 million annually. And it comes after Hasbro lowered its outlook in October. And the reason given at the time was that softer toy market heading into the holidays. 2 months later, clearly that is still the case. Even still, if you take a look at Wall Street at the sell side, it is sticking by Hasbro. This is a stock with 0 sell ratings and 10 buys. Morgan Stanley, which has an overweight rating, it wrote this morning that discussions with Hasbro management suggest that these job cuts are proactive in nature as the company maintains its focus on improving profitability. Meanwhile, you have Stiefel also saying that things likely do not get a lot worse from here. But it's important to point out that this isn't a problem just for Hasbro. You take a look at rival toy maker Mattel. It's also had to contend with a weaker toy market. But then you think about the success of the Barbie movie over this past summer. Mattel is looking at 6% or so gains this year. You compare that to Hasbro, down about 20% in 2023, down another 3% or so this morning.
Brutal. Katie, thanks for the update. Just absolutely brutal. We're talking about a toy maker cutting almost 20% of the workforce 2 weeks before Christmas. David Leibovitz, Victoria Fernandez back with us for more. Victoria, let's talk about it. Is it a Hasbro problem or a consumer spending problem?
Well, it's an interesting question because you look at the report that Amazon put out after Black Friday, and toys was one of their largest selling sectors that they had. So you have to wonder, is it more related to the Hasbro toys themselves? But look, the consumer has pulled back. We know they've pulled back. We know they're being more cautious about their spending, even though they're still out there. I want to say it's only up about 3.5% year over year on spending on holiday, which is lower than the average. So I think it's going to be more of a Hasbro issue per se in the toy sector, but we know we're probably going to see more. Look, you had State Street lay off, 15,000 workers last week. We're going to start to see some of these chinks in the armor of the labor market, and that is where I think we'll actually start to see weakness flow through the economy. That's probably what the Fed is looking at. But I still think we'll have a decently strong holiday season on shopping.
David, which one is it? Is the consumer doing better than okay or falling off a cliff?
So I think that the consumer is hanging in there. I mean, I think that when you look at what's going on with job cuts, it's proactive. I mean, we saw this with tech in 2022. This is just a way of businesses defending their margins in an environment where pricing power is fading. And so, I don't really think that we're seeing meaningful cracks in the consumer. Yes, labor markets have cooled marginally, but we also just added 200,000 jobs in the month of November and saw the unemployment rate move lower to 3.7% with 4% plus wage growth. And so, to me, that's not necessarily a near-term recipe for weakness in the consumer, but I would agree with Victoria. I mean, this is going to be all about the jobs market as we look forward, and any significant cracks in the labor market are going to get the Fed to change their rhetoric relatively quickly.
So we haven't seen significant cracks yet, David, and it makes me wonder. We have seen big moves in the equity market. Breadth's improved. We've seen cyclical parts of equity start to do well. Airlines are on fire again going into the holiday period. Now, I just wonder whether you think that's a mistake or the right trade going into year-end and beyond.
So I think that there's still some upside in risk assets. Obviously, seasonals are relatively favorable, and I could well see the equity market grind higher into the end of the year. I think at some point you're going to need to reconcile the level of interest rates with what's being priced in terms of Fed policy going forward. And to me, that maybe gives the equity market a bit of indigestion during the first few months of 2024. But we are relatively constructive on the outlook for risk assets from here. We don't see a recession coming next year. We see inflation continuing to trend lower. And historically, that's been a pretty decent environment for financial assets, particularly if the Fed is able to ease in the back half of 2024.
Victoria, I'll ask you the same question in a different way. The improvement in breadth we've seen over the last month, do you see reasons for that to continue?
I think it could continue if we continue to see the inflation come down, right? We've had this easing of financial conditions, and so that's going to be supportive of these companies. But a lot of it is depending on their pricing power, and we've been talking about that this morning, what that means to their margins. As inflation comes down, pricing power diminishes for these corporations. And if their costs aren't going down tremendously, those margins get squeezed. We're going to see that come through in the earnings. And it usually takes about 12 to 18 months after the Fed starts hiking rates that corporations feel the pain and then start laying off workers. So if we're just now getting to the point where we're starting to see that, that could ramp up and cause issues for earnings, for the labor market going forward. So I think we have to be cautious. As I said earlier, I think short term, you're good. You have some tactical moves you can make, and the trend is probably a little bit higher. But longer term and going into next year, I think you have to be a little bit cautious because of these warning signs that we're seeing.
I think you're both on a similar page. Victoria Fernandez, David Leibovitz, to the both of you. Thank you. Going into the opening bell about 8 minutes away. Equity futures pulling back just a little bit. On the S&P, we're down by 0.1%. Take the inflation data largely in line. I say largely in line. At the front end of the yield curve, in the bond market, a 2-year high by a single basis point. The yield there about 4.72 on a 10-year, down about a single basis point on a 10-year to 4.22. Coming up on this program, the morning calls and later, dare to dream or fear a mild recession. FS Investments' Troy Gajewski seeing 2 potential scenarios for markets and the U.S. economy. That conversation just around the corner.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Stocks just a little lower. Let's get you some morning calls this morning. First up, Citi, downgrading Macy's to sell, expecting its recent buyout offer to never materialise. Your second call from Morgan Stanley, upgrading Sonos to overweight, pointing to new product launches and an attractive valuation. And finally, Barclays downgrading Airbnb to underweight, saying recent data points to slowing demand and mounting competition. That stock is negative by 3%. Coming up, Ford slashing EV production targets as Hasbro cuts 20% of its workforce. That conversation up next with Troy Gajewski of FS Investments. Your equity markets slightly negative near session lows. We're down 0.1%. Your opening bell is up next.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
No drama from the CPI report, setting up Chairman Powell tomorrow. One question, does he push back against this monster rally we've seen over the last 2 months? Your equity market right now pulling back by 0.1% on the S&P 500 on a 6-week winning streak. If we make it 7, the longest weekly winning streak since November 2017. There's your opening bow. Switch on the board and get to the bond market. Yields look like this, going absolutely nowhere on a 10-year, 423.51 in the FX market. Dollar weaker through much of this morning through the bulk of G10, 107.84, 107.83-ish on the euro against the US dollar. That currency pair positive by 0.2%, and crude pulling back into the 60s, 69.30 on WTI. We're down about 2.8%. About 20 seconds into the session, equities pulling back just a little bit. We're down 0.1% on the S&P. The Nasdaq going almost nowhere on the Nasdaq this morning. One stock to watch going somewhere, Hasbro, in the wrong direction. The toy maker cutting close to 20% of its workforce due to slumping holiday sales. Abby has more. Hey, Abby.
Hey, John, it's interesting that the stock at this point is well off of its lows, down just about 1%. As you've been making the point all morning, it's not really a good sign that a toy maker is cutting the workforce by such a degree, about 20% or 1,100 workers over the next 18 to 24 months, 2 weeks before Christmas. And they are citing slumping demand for toys. This isn't completely a surprise, though. In the last quarter that they reported, they highlighted the weakness and the sluggishness. They reduced their gross margin guidance for the year to 13 to 13.5% from 16 to 20%. But it wasn't just a matter of profitability. Revenues also came in. They were down 10% year over year. For the guidance, they brought that in relative to the year as well, saying that sales would drop about 15%. It's interesting, though, because we do have analysts defending this name, as Katie was pointing out earlier. Stifel is saying that the worst is likely over. Morgan Stanley saying that the cuts are proactive. The stock down 2%. I would note on that last quarter that was a miss and a guide down over 2 days. The stock did fall about 17%, so some of it priced in there. On the other hand, John, on the year into today, the stock down about 20%. There's a 5% short interest, which from quick analysis, it doesn't sound like a true kitchen sink moment if one needs to be had. Stay tuned on more for Hasbro.
Down 1.5%. Abby, thank you. Abby and Katie mentioned in that note from Stifel. Here's the call from them. Cutting the price target down to 64 following those layoffs. Here's the quote. Things probably don't get a lot worse from here, but given the seasonality of the business and another disappointing holiday, we find it increasingly difficult to justify paying a higher multiple, at least over the interim. That name is now down by about 2.4% and down hard from the highs of a few months ago. I want to turn to earnings season, sinking this morning. Oracle reporting weakening sales growth within its cloud computing business. Alex Semenova has this one. Morning, Alex.
Good morning, John. A second straight quarter of slowing growth for Oracle's cloud infrastructure business. That's fueling investor concerns that the company's expansion efforts are failing to gain ground in a competitive market. The stock was down as much as 9% in pre-market trading. That's the most since September. You can see shares moving lower into the open as well. Cloud revenue rose 25% to $4.8 billion in the period ended November 30th. That's slower than the 30% gain in the prior quarter. Now, Oracle had been focused on broadening its cloud infrastructure business to compete with the likes of Alphabet, Microsoft, and Amazon, but that initiative hit a bit of a speed bump back in September after a year of accelerating growth. Executives still remain bullish on the business. Chairman Larry Ellison said today, quote, the demand is, quote, over the moon, and Oracle will continue to accommodate that demand. It's going to build out 100 new cloud data centers as part of that effort. The reaction from Wall Street analysts was a little bit less upbeat, though. Morgan Stanley said that it's waiting for more upside to justify the valuation. Bloomberg Intelligence analysts flagged supply constraints. They said growth coming in below estimates was the result of a shortage in the availability of AI chips. That's something they don't see reversing anytime soon. The stock is still up 40% year to date, John.
It's down this morning. Alex, thank you. It's down by 9.6%. The move this morning, downbeat, that's for sure. Also watching shares of Alphabet, Google losing its antitrust court fight to Epic Games. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. Google, or Alphabet, the parent of Google, down 0.5 percentage point. Basically, the jury of 9 in San Francisco decided that the Google Play App Store does represent a monopoly based on anti-competitive practices by parent Alphabet. They reviewed a large body of documentary evidence, internal memos that looked at the dealings of how Google Play was grown and the Android operating system, and identified specific practices. For example,
a practice of sharing revenue from Google Play with mobile device makers in return for being the app store of choice on the home screen of any phone that uses Android as an operating system. Google inevitably and understandably are going to challenge this decision, which is different to the outcome of what happened in the Epic and Apple trial. But what happens next is that the judge who presided over this case will have to decide whether or not to enforce a change of policy for Google to allow app distribution outside of Google Play and another means of payment outside of Google Play. Our colleagues at Bloomberg Intelligence estimate that if that were to be the case, there would be a headwind to growth of 1 to 2 percentage points, which is the tangible impact here. Overall, the download or app market across Google and Apple was $200 billion a year. So there's a lot at stake, although these legal proceedings have a number of avenues for challenge. And as we learned in the Epic and Apple case, which is being reviewed by the Supreme Court, we could see this play out for a number of months.
Ed, thank you. Look out for more coverage on this story with Ed Ludlow and Caroline Hyde on Bloomberg Technology in about 2 hours and 30 minutes. Let's stick with tech. Cathie Wood boosting her stake in Microsoft and Meta as Warren Buffett cuts his HP holdings by nearly 50%. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, uneven appetite for tech here. Let's start with Cathie Wood buying Microsoft and Meta in the ARK Next Generation ETF. We're talking about pretty small numbers in dollar amounts, just over $3 million a piece for those shares. But this was the first time that ARK has bought Microsoft in 9 months, the first time that ARK has bought Meta in 5 months. So clearly some demand returning there. Can't exactly say the same for Berkshire Hathaway and HP. Berkshire has cut its holdings in the PC maker by nearly half over just the past couple months. That is according to a filing which shows that Berkshire is on track to be a seller of HP for a second straight quarter. Now, it has been a rocky time for the PC industry working its way out of a post-pandemic bust. HP has actually managed a 13% gain so far this year, but that pales in comparison to some of its rivals, and now you have Berkshire backing away as well.
Katie, thank you for the update there. About 7 minutes into the session, we're down about 1/4% on the S&P 500. On the NASDAQ, we're down about 0.1%. So many outlooks across Wall Street over the last couple of months. The crystal ball season looking out to 2024 and beyond. Troy Gajewski of FS Investments discussing his outlook for the year ahead, writing this: the scenarios for future economic activity really boil down to just 2 plausible outcomes. We stay in the dare to dream environment for multiple years, or we enter a mild recession at some point in the next 6 to 18 months. Troy, not helpful. Let's get straight to it. What's more plausible in your mind, one or the other?
Yeah, so I think, again, in an environment like this, you should practice some degree of humility and not pretend to have a crystal ball over precision. I think from a standpoint of dare to dream versus mild recession, on the margin, we'd still say mild recession, primarily because withholding tax growth has rolled over now for 3 quarters in a row, which tells you that gradually the consumer is weakening. And again, every classic recession indicator, whether it's bank underwriting standards, inverted yield curve, the pace and magnitude that the Fed has tightened at, the lagging effects of monetary policy would tell you on the margin it's slightly above 50%, call it 50 to 60, and then dare to dream is roughly 40 to 50. And so the point there is you have to plan your asset allocation accordingly and lean into strategies that can benefit from higher front-end rates, and not get too over your skis now in beta, given how high multiples are, and also in terms of duration, because we've had a massive snapback rally from 5% to now 4.2 and change.
Well, let's talk about your approach right now, currently, and how you expect it to evolve in the coming quarters.
Yeah, so look, I think it depends on the strategy. One of the things we're really excited about in private markets right now is middle market private equity. So if you think about where growth stocks are, and let's all say clearly that the Magnificent Six, maybe Tesla, maybe not, are wonderful companies, but they're trading at 32 times forward earnings. And in middle market private equity, typically you have much less leverage, which is very important because cost of leverage has gone up so much. You have cheaper pricing, and you have natural organic growth because you're only talking about growing these companies' EBITDAs from 10 to 30 million or 20 to 40 million over time. And you don't have the dramatic whipsaws that come with the multiple compression we had last year or the multiple expansion we had this year. So when you're thinking about ways to generate growth and attractive risk-adjusted returns, we really like middle market private equity with a heavy emphasis on secondaries because there's a huge overhang of institutional allocation to private equity. There's a need and a desire to lighten up,
particularly on older vintage funds. And so you can swoop in and buy these at pretty significant discounts, sometimes as much as 30%, typically 10 to 20. And that the volume of that market's expanded from, sub 10 billion, 10 years ago to consistently over $100 billion now. So we think that's one of the few areas in markets right now where you can get growth-like outcomes without taking undue risk of further multiple compression or a mild recession.
Troy, we hear so much about entering private markets. We spent some time, a whole morning, in fact, with Apollo just a week ago and talked about the opportunities there. Troy, do you think we've seen the pain in private markets before we really get our hands around the opportunities that exist?
Yeah, that's a really good question, John. I think the nature of the way private credit liability structures are set up, and that, private credit tends to have very long liability structures. Private equity, even in evergreen democratized solutions, have longer liability schedules. There's never like a Minsky moment where you're forced to sell, or a deleveraging moment or a solvency moment like we had with banks in the past. Clearly, in private credit, you're going to see defaults go up. But in a mild recession, they shouldn't go up dramatically. And in the meanwhile, you're earning a much higher base rate yield than anyone dreamed of, including myself 2.5 years ago. And if we stay in that dare dream environment, then you don't have the natural decline in revenue and further EBITDA compression. Up until now, EBITDA has been very resilient. Obviously, free cash flow is down a bit because interest expense is up so substantially. But in the event that companies have liquidity issues, there's a huge war chest of private equity that's there to step in and provide a ballast. And in the meanwhile, we're really focused on extending credit to companies that are very robust. They're just having short-term, modest liquidity issues. And if they can get a bridge loan over a certain period of time, that can dramatically reduce the risk of bankruptcy going forward.
Troy, one thing that Mark Rowan talked about, and I wonder if you agree, is that the opportunities for alpha in public markets have diminished because of the proliferation of indexing to public markets, just say an index, the S&P 500. Troy, is that something you agree with?
Oh, yeah, 100%. I mean, look, there really hasn't been meaningful alpha in the equity part of the capital structure since before the GFC. The short rebate went away. And so much that it's because, we have roughly 40% fewer private companies now, or public companies, I should say, after Sarbanes-Oxley, and roughly 40% more private companies. You certainly have more alpha potential in the middle market than in mega cap buyout shops. But yeah, in terms of alpha, it's very difficult to add it in the equity part of the capital structure. And you think about this year as a classic example. I mean, the rest of the markets kind of lagged dramatically, and the Magnificent Seven have driven the entire return almost of the S&P up until recently. So unless you're overweight those companies significantly, or you're levered long, which by definition isn't alpha, very difficult to outperform a market cap weighted index in an environment like this. So we'd agree with that statement wholeheartedly.
I just want to squeeze one in. Just one more question, Troy. Just going into next week, into tomorrow rather, what would you look for from Chairman Powell after these inflation numbers?
Yeah, so look, I mean, you think about the labor market report, the NFP report, you think about today's inflation. The Fed should continue to articulate, like they've done recently, data dependent. We're in no rush to cut, right? The risks are symmetrical, but they're symmetrical. They're not dramatically skewed to the downside, as many of the bond permeables have been arguing for 18 months. So they should push back hard on cuts next year. The probability of a cut in March is almost non-existent, even June. I'd really be surprised if they cut by 100 basis points by the end of next year. I think the soonest we could see them cut is, Q3, maybe 25 then, 25 in Q4. But that will depend upon continued economic slowdown and improvement on inflation. And we all know the last mile on inflation's a lot higher. It's a lot harder to get core CPI from 3 to 2 than it is from 5 to 3.
Yeah, without a doubt. Troy, thank you. Troy Gersky there of FS Investments. Troy, enjoy Christmas. Good to catch up, buddy, as always. About 13 or 14 minutes into the session, equities pulling back just a little bit. We're down a third of 1% on the S&P and on the NASDAQ as well. If you look across the yield curve right now, the 2-year out to the 30-year, yields up just a little bit, a basis point or two. On a 2-year, up 2 basis points to 473. On 10s, we are in and around 425. Coming up, what a story. Ford slashing its EV production plans.
We've seen prices come down in the electric segment much quicker than we expected. And the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices.
Shares under pressure, a grim sign for the EV market. That conversation up next.
or pause this week?
Most measures of underlying inflation have continued to ease.
Is the ECB done?
She did not say no further increase.
Bloomberg Television and Radio brings you the breaking news and detailed analysis after ECB President Christine Lagarde's press conference.
Inflation is coming down faster than it went up.
The ECB still underestimates, the turn of the credit cycle.
Coverage begins Thursday on Bloomberg. Context changes everything.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We've seen prices come down in the electric segment much quicker than we expected. And the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices. Early majority of customers aren't. They're not willing to pay that premium. The adoption rate, it's flatter than what we had expected. The increase isn't as great. 50% up this year from a sales standpoint. So they're coming. It's going to be part of the industry. Eventually we'll get to those higher growth rates.
That was the Ford CFO, John Lawler, weighing in on EVs and the consumer weeks ahead of the company slashing its 2024 production goals for the electric F-150 due to slowing demand. At its 2021 unveiling, Ford CEO Jim Farley calling the truck, quote, a test for adoption for electric vehicles in America. The slowdown, an ominous sign for President Biden's 2030 EV goals. Your team coverage starts right now with AMH in Washington, Ed Ludlow in San Francisco. Ed, some difficult numbers from Ford.
Yeah, and the narrative from Ford is that they are matching production to what is there in terms of consumer demand. What that looks like in real terms is that they're currently building around 3,200 F-150 Lightnings a week. Next year, they'll build 1,600. The average selling price right now for an F-150 Lightning across the variants that are available in the market is about $65,000 US. And it's interesting. Look at Tesla. I think it's down around 2%. Rivian down around 4%. You know, they also have pickups with much higher average selling prices. Cybertruck, there's a lot of fanfare right now, but the base model that's just under 61K doesn't come to market until 2025, which kind of speaks to this idea that the early adopter that will pay the higher average selling price may have been and gone.
Anne-Marie, where does this leave the president's goals?
Well, Jonathan, this goes back to April when the
the Biden administration, along with the EPA, proposed these rules that were so tough on tailpipe emissions that basically would mean that every automaker would have to sell 2 out of every 3 of their cars being EVs by 2032. The issue is the demand doesn't seem to be there right now. And just a few weeks ago, we heard from about 4,000 dealerships across from the United States penning a letter to President Biden. And they're saying they're agnostic, Mr. President. We just want to be able to sell cars. But we have to be able to make sure that the customer demand is there. And they're not seeing that at the moment with EVs past what Ed called early adopters. Quote, with each passing day, it becomes more apparent that this attempted electric vehicle mandate is unrealistic based on current and forecasted customer demand, Jonathan.
We're pushing these automakers into a corner, Ed. The demand's not there. Are we finding out that consumers don't really want EVs, they just want Teslas?
A question that I have, and we're actually going to speak to the White House later on the show, Jonathan, is what from the Inflation Reduction Act is currently reducing inflation? In other words, did the what is set out in the Inflation Reduction Act in the context of consumer EV benefit actually do anything? You know, what's worrying is that in the month of November, F-150 Lightning had its best ever month. Sales were down sharply in the third quarter, but that was a supply issue where they had shut down production. So what is it that they're seeing next year in the consumer that we're not seeing? What is it that has caused this sharp reaction? And, we are backing them into a corner, but clearly they're acting proactively based on something they're worried about into 24.
Anne-Marie, you get the final word, please.
Well, when it talks about what's going on with the consumer, if you read through this letter, what the auto dealers are talking about is there's still a number of consumers that are concerned about range, about making sure that they have accessibility to be able to charge these types of vehicles. So as you have this, what they're calling an EV mandate, you also have a push from the administration to make sure that there's charging stations. And if they're not moving in parallel with each other at the same pace, it's going to be very challenging.
Range anxiety is real. It is real. Anne-Marie, thank you. Ed Ludlow on the latest big reality check for the EV market from Ford overnight. This is the reality check, if you want to call it that, from Secretary Yellen this morning, communicating through a Wall Street Journal event. She sees no reason inflation shouldn't gradually fall to 2%. The latest reaction this morning from the administration to the CPI data of about an hour and 22 minutes ago. Since then, equities are doing okay and then pulled back. On the S&P, we're down by about 0.1% on the S&P 500. 22 minutes into the session on the Nasdaq, we're down about 0.1% also. Let's get you some sector price action. Here's Abby.
It may be a small decline for the S&P 500, John, but it is broad-based from a sector standpoint. Most sectors for the S&P 500 are lower at this point, 8 of 11 to be precise. To the upside, materials, financials, and industrials hanging on to small gains. Then we have the rest of the sectors down not so much until we get to communication services, down about 0.5%, utilities down about 0.7%, energy down 1.5%. In fact, let's hone in a little bit more on energy, that sector. It is in the month of December down 4.1%, heading to a third down month in a row, matching the longest losing streak going back to October of 2020. This, of course, today we have oil, WTI back below $70 per barrel. Those OPEC plus production cuts not just getting the job done for oil.
Down 3%. Abby, thanks for that. Back in the 60s, a break of 69 just a second ago on WTI, 68.99 for a second or so. On Brent, 73.70, down 3% there as well. Coming up on this program, the Trading Diary, a week full of economic data and central bank decisions. A sneak peek of that calendar up next.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg.
Close to 26 minutes into the session, snapping a two-day winning streak on the S&P. For now, let's see if it sticks. We're pulling back 0.1% on the S&P 500. That's the price action. Here's the trading diary. A sneak peek of the calendar for the week ahead. The US Treasury selling $21 billion in 30-year bonds at 1 p.m. Eastern. Wednesday, PPI numbers in the morning. In the afternoon, a Fed rate decision, forecasts, and Chairman Powell news conference. Thursday is the ECB's turn, along with the Bank of England, and we get US retail sales. The next 2 days, incredibly busy for this market. From New York City, that does it for me this morning. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Top names in global leadership are on Bloomberg.
What we've just delivered are significant tax cuts. For business, we will be the only major G7 economy, certainly, and even broader than that, where you get a total write-off against your taxes for capital investment. And it comes on top of the fact that our corporation tax rate here is lower than any other G7 economy. That's an incredibly generous regime to attract business investment.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Get his thoughts on that inflation print we had today and what we might hear from his Federal Reserve tomorrow. And then we're also going to check in with Jody Laurie, credit analyst with Bloomberg Intelligence. She's going to join us to break down Choice Hotels' proposed hostile takeover of Wyndham. How about that? And then we're going to talk about the ETF biz. Sean O'Hara, president at Pacer ETFs. What are the flows looking like in the ETF space, and what's his outlook for 2024? We'll get all that in the upcoming hour. But first, let's kick this things off with Mr. John Tucker on a Bloomberg Business Flash.
You know, there's not a lot to say, I'm going to say. Treasury yields, little changed. The major stock averages, little changed, while inflation is moderated from a 4-decade high. The data that we got this morning kind of underscores the difficulty of taming the beast. You have core consumer prices accelerating in November, rising 0.3%. Right now, the S&P 500, 5 points lower. That's down 0.1%, 46.16 on the index. The Dow, 12 points lower. Right now, the NASDAQ 100, 20 points higher. That is up 0.1%. Dana Peterson, the chief economist at the Conference Board, reacted to this morning's inflation report.
Well, I think the key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects. But real wages are rising, and certainly it's supporting consumer spending. But when we ask consumers how they feel, they're still complaining about inflation. They're still saying that everything's too expensive.
And the S&P 500, most of the major industry groups are lower right now. The biggest drag, that's coming from energy as we see oil prices decline. NYMEX crude right now down $2.23 a barrel, under 70, 69.10 a barrel. Up next, the Fed's meeting, and of course the dot plot that could give us an idea of rate cuts next year. Market breadth, is it overdone? Gina Martin Adams of Bloomberg Intelligence saying 65% of stocks are above their 200-day moving average. Plenty of participation, as she puts it. That was a great interview.
That was.
Gina. I mean, she's
the best. I wonder who hired her.
You're going to take credit for this, aren't you?
Of
All
course
right.
he is.
We check
That was
the
an easy
markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
John Tucker. Perfect. Thank you very much. We appreciate it. Jess Menton sitting in for us again for the next 3 hours. Thank you so much, Jess.
The minister is back.
The minister is back. So you married another person.
I did. Officiated another wedding over the weekend.
Wow.
My best friend, Kaylani.
Remind me, it's like official when you do it, right?
Well, apparently, I got a certificate in the mail, a sticker. I also got a little clip that says clergy on it that I can wear around.
Oh, man. So, I mean, I had a priest. That's how you do it back in the day. I mean, in a mass church, that's
do
how
we
you
have
do
to, like, watch our language and behavior?
Right in front of the minister here.
But
She may marry you again, John. You've got to be careful.
Right.
I'm
Congratulations,
John.
Kaylani and Matt.
Kaylani and Matt. Very nice.
Been my best friend since I was 6.
Oh, great.
That's
Awesome.
great. People laughed. They cried. I feel like I did a great job again.
Very good. That's the feedback we got. All right. We'll check that out. Jess Menton, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Red and green on the screen. Not a lot happening at the index level. Let's check under the hood. And we can do that with a pro, Abigail Doolittle. She covers all the markets.
She's the best.
She's the best. She joins us here in our Bloomberg Interactive Broker Studio. Go, Abigail, what are you looking at?
Thank you for such kind words. I have to come in here more often. It's a nice little boost. So relative to stocks, it's interesting to see that we had the initial reaction to CPI that was relatively benign, maybe even a little bit positive. You had yields going down. That helped stocks go higher. Now we have yields mixed. The 2-year yield is actually up 1 basis point, firmly above its 200-day moving average. And then the big event tomorrow is the FOMC. And so the question there is, will Fed Chair Jay Powell, or will even the commentary in the policy statement itself somehow tamp down these market watchers who have been informally calling for a Fed pivot? So today we're treading water. I'd be surprised if we see much bigger moves than what we're seeing here. But yeah, lots of movers beneath the surface.
What's the technicals telling us at this point?
I actually have a chart pulled right up
Yes,
here because I heard you guys talking about the great Gina Martin. And so breadth may be robust. One thing I would say is we're 7% above the 200-day moving average. Back in July, ahead of that, near correction for the S&P 500, true correction for the NASDAQ 100, almost bear market for the Russell 2000, we were 12% above the 200-day moving average, so not quite as overextended. The RSI, I know that you both have come to love the RSI.
I was just about to ask you that because if you look at it for the S&P, still above 70, but I was actually talking to Andrew Thrasher, he's a technician and portfolio manager at Financial Enhancement Group, talking about even when you see that, a lot of times technicians like to look not just on a daily, but more of a weekly, monthly, and so it's a little bit different. So even though if you see RSI above that, doesn't necessarily mean markets have necessarily topped. What's your feeling on that?
I would agree. Ari Wald, I would say it's not even a matter of, I don't think of it in terms of necessarily topping. I'm just looking at it as a tool for momentum, which might indicate whether or not there's a direction change. Ari Wald over at Oppenheimer, who is one of the truly great technicians out there, he taught me years ago that what you want to look at in an RSI, a rising RSI is not bad. It's not a sign of a top necessarily. You could have an RSI go to 90, 95 because that's great momentum. The minute you start to see a lower high, such as we have for the S&P 500, that's suggests that the second round of momentum to the upside is waning, which suggests that the bulls on some level are losing appetite to buy stocks a little bit. So that's the case on the S&P 500. Still, the index is right above 4,600, but I would suggest it's facing that resistance there. When I pull up the 2-year chart, I love doing live charting like this. So it's almost overbought. It came off of a pretty solid bottom back from that October low. From a monthly perspective, which really smooths out the picture even more, it's actually right around the area where it topped out, to your point of whether or not it's a top, but in a different way than you were referring to back in July. Yeah, and when I take a look at the monthly chart, what really does concern me is you have the S&P 500 130% above its 200-month moving average, so very overextended. That was back in July, and right now 100%. Probably some consolidation would be healthy. December seasonally is not the month for it, but if anything were to do something along those lines, it would be the Fed tomorrow basically swatting back at these market participants saying that there's a pivot of some sort that has happened and that there's going to be 100 basis points to 125 basis points worth of cuts next year.
I'm going to ask this question on behalf of Tom Keene. What does a VIX of 12 tell you?
So there's a lot of different ways to look at the VIX right now. So the first answer would be complacency, that investors are not looking to hedge. But if they're not looking to hedge, given the amount of uncertainty out there, what are they doing? So we, of course, have those zero-date expiration options. So there's a lot of folks trading options that expire on a daily basis. You also have a 2-year yield that's at 4.72. So if you wanted to hedge your portfolio of stocks, you could earn 4.7% while doing that. So I think that given that backdrop, I think that the complacent answer still sticks, but I think that there's some other factors to take a look at.
All right, very good. Abigail Doolittle joining us here in our Bloomberg Interactive Broker Studio. We appreciate getting the time. Abigail covers all the markets.
I think she's going to be back with us a couple times later.
Well, look at you looking ahead here on the schedule.
I look at our schedule.
Yeah, come as you go. I mean, it's just kind of, as soon as it comes up, we go. All right, let's go to Ira Jersey. Why? Because we kind of have to, because it's a Fed
football,
day
soccer, but then also rates in the Fed ball.
All right, he's down safely ensconced in Princeton. His 1 day per month up in New York. I think we got that last week, so we appreciate him. Ira, I mean, the Fed, I'm looking at the CPI data. Let's start there. What did the inflation data say to you this morning?
Yeah, well, obviously it wasn't much of a surprise from what the consensus was, but I think the market was thinking that maybe it would be somewhat lower than expected, right? So CPI and inflation slowing a little bit more, particularly after we got the weak wage data out of the UK and some other data out of Europe that suggested that maybe inflation is slowing a little faster there. When we didn't get it, that's one of the big reasons I think you've seen the market sell off a little bit since the number, where you have, and when I say the market, I mean like 10-year Treasury yields or 2-year Treasury yields, which both are somewhat higher than they were prior to the number. So people are probably position squaring, getting set up because they don't want to go in with big risk going into tomorrow's Fed meeting.
What does the speculative positioning look like when you're thinking about CFTC data and hedge fund positioning in particular?
Yeah, so when we look at a lot of the data for positioning, it just does suggest that people who are long are starting to get out. Like there's some JP Morgan data, Treasury sentiment data from JP Morgan that came out today that suggested that longs were cut significantly. So people are, certainly thinking about taking some profits here, because if you got in when 10-year yields were at 5% and to where we are now, you're up 5 or 6% probably in your portfolio just over the last 60 days or so. So why not kind of cut bait? Don't take a lot of risk before the Fed, and then take some gains before year end, and then figure out where do you want to be positioned for 2024 after the holidays.
Dots go, DOTS go. Explain to me how I should look at this stuff tomorrow.
Yeah, so keep in mind, like people have been talking about there being, 2 cuts priced into the dot plot. That's actually not true, because the two cuts that are priced into the dot plot as of the September meeting were predicated on 1 hike in between the September and December meetings, and we're probably not going to get a hike tomorrow. So in that situation, I do think that the Fed's probably going to say, we are going to cut 50 basis points in 2024. So therefore, that 2024 median dot will probably come down just a little bit. Probably, like I said, I think 1 cut. A surprise, I think, would be more than 75 basis points. So if the Fed came out and said, "Hey, we actually think we're going to cut 100 basis points next year," that would be a signal that that would have to come in conjunction with the rest of the summary of economic projections, saying that they were going to have much lower inflation and much slower growth and higher unemployment than what they said in September. And based on the preponderance of the data, I'm not sure that we'll get that. That's why I think that they'll kind of go somewhere in between and say, we think we're going to cut, but it's only going to be a little bit.
One thing I was curious about, Ira, so Austin Goolsbee, Patrick Harker, Lori Logan, Neil Kashkari, they're all voting members this year, but that's going to change next year when Loretta Mester, Thomas Barkin, Raphael Bostic, and Mary Daly come in as voters instead. When it comes from the bond market point of view, how do those changes potentially affect how traders are positioning for potential cuts next year?
Yeah, so that's, we always talk about, there being voting members being slightly more dovish in 2024 than the group that's voting today. But they all still sit around the table. They all talk. Certainly Jay Powell and others want to have some form of consensus or near consensus before they even go into the room. So I suspect that that change won't mean a whole heck of a lot, although, that being said, I think if we do get inflation continuing to meander lower, that maybe you could get a slightly earlier cut than you would have if you had some of the more hawkish members still on the committee. But again, in my view, you're still talking about like a meeting. You're not talking about months. And I still think that the pricing for interest rate cuts in the first half is at this point a little bit premature. And I think there's a real risk that people in those positions are going to wind up finding themselves cutting themselves short because they're the Fed, if they do go, they're probably going to go a lot, and but that doesn't seem like it's likely. Look, a preponderance of the data suggests that we're on a slowing but not slow growth trajectory. You had decent payrolls, decent wage growth, higher hours worked, and then you had a kind of a steady state inflation report today. So all of those lead me to believe that, yes, maybe the economy's slowing, but it's slowing very, very gradually.
And for what it's worth, the bank rate 30-year fixed mortgage now down to 7.3%. So it's certainly trending lower. Ira, have we seen peak rates? Is that kind of the accepted deal out there in the marketplace?
Yeah, I think a lot of people think that we have. I thought we saw peak rates when we were at 330 when we're at 4. Well, when we're down to 330, I thought we had seen peak rates at 4.5% or 4.35%, and obviously we sold off significantly above that as well. So I think we've probably seen peak rates of this cycle. I do suspect that we'll see even higher interest rates the next cycle, but it's going to take, again, a kind of a reacceleration of growth and inflation sometime down the line before we break 5% again on 10-year Treasury yields.
Talk to us about Treasury auctions. What's your view heading into year-end and the potential performance there and how that could affect the bond market?
Well, we have a 30-year auction this afternoon, so look for that at 1 o'clock. You know, the 30-year auction last month, which was a new, what we call a refunding auction, so that was a new bond that was issued. It went pretty poorly, so today we'll see if it goes weak as well. We had 2 auctions yesterday. Neither of them was particularly good, quite frankly. So the thing about auctions is that sometimes they're difficult predictors for what performance is going to be after those auctions. So it's really only a point in time that it's telling you. But you have seen, as supply has increased, needing that the Treasury Department has needed to increase the size of these auctions, it's been more and more difficult for investors to take them down at the prices that the market's thinking right at the auction close time. So usually 1 o'clock on the auction day. So I do think that it shows you that there is kind of a I don't want to say a supply-demand imbalance, but I want to say that investors are kind of picking their points and to take down this new supply or demanding slightly higher yields than they would if there was significantly less debt outstanding.
All right, what is the soccer match of the week that we should be paying attention to?
Well, I'm going to continue to be watching my Aston Villa. So I beat John Farrow's. We beat John Farrow's Arsenal this week. We beat Man City last week. We're in 3rd place in the table. So we're really flying up. So yeah, Aston Villa will be what I'll be watching this weekend for sure. The MLS season ended in pretty dramatic fashion over the weekend with the Columbus Crew taking home the MLS Cup. So that was a good match. If you haven't seen it, I would recommend tuning in and watching that one.
There you go. All right. So where's Aston Villa? That club, is it in London?
It's in Birmingham. So it's in the second city of the UK. Yeah.
All right. Very good. It's kind of like the Boston, maybe of.
Any game that can end in a tie, we can move on.
It's football. It's footy. It's the perfect game, beautiful game, or whatever they call it. Anyway, he's all onto it. Ira Jersey, chief soccer strategist here for Bloomberg Intelligence on the side. He also takes a look at the U.S. interest rate environment. We like to pick his brain on both of those things here, but I will not, I repeat, not be watching for the auction, the Fed auction today at 1 p.m.
Oh, no.
No, I'll let Ira do that. That's what we pay him
wonder if
for.
he's got his soccer suspenders ready.
Yeah, exactly.
For the next big game.
I'm looking at the yield curve. I mean, I got the 2-year at 4.72%, the 10-year at 4.23%. And again, just, a month and a half ago.
October 19th was when it peaked right above
absolutely
5%.
So we'll have more on that. We'll have more with Ira anytime. This is Bloomberg. Got some company news right now with Lisa Mateo.
Thanks, Paul. Slowing demand for EVs is pushing one car maker to slash some of its production goals. Bloomberg's Gina Cervetti has that story.
Here's an ominous sign for the electric vehicle market. Ford has slashed production targets for the F-150 Lightning plug-in pickup truck. CEO Jim Farley has said potential buyers are turned off by high prices and spotty charging infrastructure.
Ford is up about 1%. General Motors is facing legal issues for claims that it misrepresented multiple safety issues for nearly 2 years, even after numerous recalls. Bloomberg's Kimberly Adams has more on that.
A lawsuit accuses General Motors and 2 top executives of allegedly downplaying concerns about airbags in its vehicles. The shareholder class action alleges GM misled the public about the safety of its autonomous vehicle technology. GM did not immediately respond to a Bloomberg request for comment.
GM is up about 0.5%. Apple has offered to give competitors access to its tap-and-go mobile payment system in an effort to settle EU antitrust charges and avoid a hefty fine. Reuters says the EU may seek feedback next month from rivals and customers before deciding whether to accept the offer. Apple is down just a fraction. And after efforts to strike a friendly deal were repeatedly rejected, Choice Hotels is launching a so-called exchange offer for Wyndham Hotels and Resorts, appealing directly to its rival shareholders. Now, Choice said it holds about 1.5 million shares of Wyndham common stock. That's worth over $110 million, and has already met with the FTC on a voluntary basis to discuss the, quote, pro-competitive nature of the deal. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. We are seeing inflation, or the rate of inflation, more accurately, slowing. The CPI report showing inflation declining to 3.1% for the year. Core consumer prices climbing 4%, in line with expectations. Now investors are going to turn to the producer price index data expected tomorrow morning, and the Fed's interest rate decision in the afternoon. Also, additional economic data expected this week. That includes retail sales, and then we'll get the jobless claims on Thursday. Right now, the market averages have all turned higher, just slightly. S&P 500, 2 points higher, 46.24 on the index. The Dow Jones Industrial Average up 72 points. NASDAQ 100 right now up 40 points. That is up 0.25%. Not a great deal of movement in yields. The 2 years up 1 basis points. That is at 4.72. And as we look at Oracle, the worst performing stock in the S&P 500, shares dropping about 10.5% after the software company reported disappointing results. And then Google lost its antitrust court fight to Epic Games over its App Store control. Shares of Google parent Alphabet, they are down right now 0.7%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Met and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. It is, I guess, kind of M&A Tuesday, Jess. Choice Hotels launches a hostile bid for Wyndham. You don't see this very often, so you got an exchange offer going. I don't know what's going on.
Right, the Wall Street Journal putting out the story.
Yep, Jody Laurie, she joins. She's a credit analyst for Bloomberg Intelligence. Jody, can you explain what's happening here with Choice Hotels and Wyndham?
Sure, Paul. So I think the Choice situation is one of the more interesting ones that we've been following. Just as a quick recap, since the spring, Choice has been trying to court Wyndham into merging, and Wyndham has said no multiple times. October 17th, they made it public, and Wyndham said absolutely not. And now they're doing the 1980s style hostile takeover. Nice. They're doing, they're asking shareholders to feel free to exchange and get some cash or get stock for the new company, and we'll see what happens.
If you look at Wyndham stock, ticker symbol WH here, it's just down about 0.5%, up about 11% year to date, though. Walk us through the thought process of shareholders right now.
I mean, I think shareholders have to decide really what, at the end of the day, they want to get out of it. If they think this is a good exit point, they'll do it. If they really think that it's something that they'd rather just continue staying with Wyndham, they will. I mean, from the bondholders' perspective, the key is that for Choice, it's definitely a much less savory situation for bondholders, because obviously they're going to take on debt in order to finance this. They don't have enough cash on the balance sheet, nor do they generate enough cash flow to be able to pay for this. I mean, we're talking 4 or 5, could be up to $7 or $8 billion if, in theory, if the whole entire offer gets accepted, and they need to pay it in cash. I don't think it would get to that point. We've been saying about $4 billion, and we're talking about 6 times leverage at least.
Wow, that's higher than I'm sure you would like, and a lot of the bondholders would like. What's the rationale for Wyndham rebuffing Choice Hotels here?
So I think for Wyndham, it's a less slam dunk of a situation. Not that it's necessarily a slam dunk for Choice, but they see themselves as having a better company to some extent, at least from a margin perspective, from a global reach. They definitely have different brands. Choice is a little bit more concentrated in the U.S. And so for Choice's perspective, they're saying, okay, how do we grow globally? Well, Wyndham's a natural step. For Wyndham, they say, well, we don't really see that as much of a attractive situation for us. Just to be the biggest in the U.S. and then also have some international presence, not really as compelling.
What could be the potential regulatory issues that would be required for a potential combination like this?
Sure, and Brian Egger and Jen Rhee actually wrote something on antitrust a few months ago, which is a fantastic piece, basically talking about the fact that the deal might not go through from that standpoint. Choice has made comments that they've been talking with the FTC and sort of trying to put that to rest, saying, hey, listen, this could get blessed by the antitrust regulator gods. But I think the key concern here is when you deal with hotels, if you have a consolidation of hotels, it certainly could potentially affect the consumer, right? The end consumer has less choice in the matter, no pun intended.
Right. So, I mean, just give us what would this balance sheet look like if you were to kind of merge these two companies? Because I'm just looking at it now. It looks like they're kind of 3.5 times net debt to EBITDA today. But what would it look like pro forma? And is that a problem?
Sure. So, we did a calculation a few weeks ago. We were talking about Choice, just the inevitable potential that they could fall to high yield. And one of the things we looked at is from a leverage standpoint, if you look at Bloomberg's MODL screen, so if you look at what consensus estimates are for 2024-25, on the high end, we have over 6 times, low end, mid 5 times, both of which are above what the raters have as their threshold into high yield. And so that's, if we assume that $4 billion of debt that they could take on, that could easily get them there. That would take quite a few years to repay, and I don't know if the regulators would be the raters would be as accepting of their story as they were with Hyatt when Hyatt did the Apple Leisure acquisition.
How would this merger better position the potentially combined company to better compete with other larger lodging rivals, including Marriott as well as Hilton?
That is a great question, Jess. So I think really at the end of the day, when you think about what's going on in this mid-tier, low-tier, Marriott and Hilton are really expanding in big ways, both internationally as well as domestically. And they have been really just taking on 300, 400 new locations easily over the next year or so, and these brand new businesses that they have. And so they are blanketing the space and trying to really aggressively enter it. On the flip side, Choice has been entering the upscale. And so we have been seeing that a little bit, mid-tier upscale. They bought Radisson Americas. That was a big win for them in terms of that. But I think the industry as a whole is definitely getting a bit more competitive, particularly as we get to this post-COVID time and consumers' preferences circumstances has changed, right? Consumers are looking at Airbnbs, but they're looking at these ability to be able to live in a more comfortable environment, have a kitchen if they want to, have a little bit more affordability in terms of what they're doing. So I think we're seeing this amalgamation of businesses across the board. No one's going to stay in that upper tier only. They're going to try to span the whole entire economic scale.
So stepping back, I mean, I just booked a trip for Ireland in September of next year, and there's only one slot left. I mean, it is out of control. So what, generally speaking, we're going back to the homeland to see the peeps. Yeah, they're psyched, I'm sure. Talk to us about the hotel business in general here. Where are we now in kind of the recovery?
So, Paul, I mean, I think for hotels, so first of all, you bring up a good point that people are definitely international traveling much more this year into next year than they were last year, right? People feel much more comfortable getting on the road, going internationally, and are doing so significantly while they can. Do it while you can and while you're living and healthy. So that said, I mean, I think for hotels, a lot of them were affected very quickly by the pandemic, but recovered pretty quickly by the pandemic. Case in point, Marriott, Hilton, Hyatt, they all levered up with their revolvers and then quickly paid them back. Now, Hilton has stayed high yield rated because they haven't really made the commitment to want to be investment grade, but Hyatt and Marriott have gotten multiple notches of upgrade and have been in a much better spot. That said, there is some concern for the overall industry, particularly in the US, about financing. So these hotel companies are, they're just brands. They're managing these businesses, right? Most of them are so asset light. I mean, Choice is 100% asset light, but Marriott and Hilton and Hyatt have moved that way and are about 90 or so, in terms of assets that they don't own but manage. That said, they are all sort of looking at ways to